Good morning, ma'am. Today's the day two, and we are live now. Ma'am, can you hear me? Smita, ma'am? Okay.
Just continue from where we had stopped yesterday. Yesterday, we were dealing with valuation of perquisites. And I think we had discussed around four valuations. The four valuations which we had discussed yesterday was mainly regarding um, accommodations. Like there was rent-free accommodation, rent-free furnished accommodation, rent-free unfurnished accommodation, accommodation at concession and rent. And we also talked about an accommodation in a hotel. Okay. So these were the four perquisites that was discussed yesterday. One was rent-free unfurnished accommodation. Then there was rent-free furnished accommodation as well, along with unfurnished accommodation. When you add value of furniture, we'll get value of furnished accommodation. Then there was this accommodation concessional rent. I told you that is the last step which we do in any perquisite valuation. That is, amount recovered from employee has to be finally deducted before we arrive at the value of perquisite. Then we had talked about accommodation in a hotel, lower of 24% of rent paid, 24% of salary or rent paid by employer, whichever is lower. Let's continue with the other valuation of perquisites. We are going to case 5. But before we go to case 5, we have to discuss something called as specified employees. Because from now on, certain perquisites that we are going to discuss, that is taxed only in the hands of specified employees. Specified, just identify them as special employees, someone who is special in this organization. Only in the hands of those employees, certain perquisites that we are going to discuss now are taxed. So let us see. Who is a specified employee? Who is a specified employee? Specified employee is a person who satisfies any of these three conditions. There are three conditions if you are to be called a special person in my organization. Either you are a director in my organization, you are an employee as well as a director in my organization. That is the first category. Second category is you are the major shareholder in my organization, and that major limit is you hold 20% of voting right in your organization. You are an employee, you are a shareholder, and you hold 20% voting right. Then also I'll call you a specified employee. And the third one is a limit that was fixed very long back. For the same reason, I think any person will be a specified employee under category 3. Category 3 says that the person, an employee whose income under the head salary, excluding non-monetary payments and after deductions under section 16, that is after standard deduction and all, exceeds 50,000 per annum. So a person whose taxable income under the head salary exceeds 50,000 will be specified employee, meaning a person whose gross salary is above 1 lakh, he'll be a specified employee. Gross salary means it will be somewhere around 8,000 per month, 96,000. So almost every employee which will be there for your calculation, I believe he has to be a specified employee, because hardly we get anybody whose income is less than 8,000 per month and all. Anyway, these are the three categories for classification of an employee as specified employee. If you fall in any of these three categories, you will be called as a specified employee. Any of these three categories. Which are they? The first one is you are a director of my organization, of my company. Second, you are a major shareholder in my company. Major shareholder means you hold 20% voting right, 20 or more, 20% voting right, minimum 20%. The third one is, which might be applicable to all, a person whose income under the head salary exceeds 50,000 per annum, then also you will be called as specified employee. Okay. So now, let us come to valuation of perquisites. Who is a specified employee? We have already seen, because from now on, as I told you, certain perquisites are taxable only for specified employees. Okay, only for that special category of persons. Now let us see what is the next perquisite. The next perquisite is regarding gas, electricity, and water, which is supplied by the employer free. Okay, the employer, he is taking care of my domestic cooking gas. He is taking care of my domestic electricity bill. He is also taking care of my water supply. Now, there are two situations in this case. There are two situations. The first case is the bill is issued in the name of employer. Okay, the bill is issued in the name of employer, or the bill is issued in the name of employee. In either case, the payment is made by the employer. There is no doubt about that. Payment is made by the employer, but in whose name the bill was issued, or in other words, in whose name the connection was taken. The domestic cooking gas, who had taken the connection. If the connection is in the name of employer, then payment will be made by, then bill will be issued in the name of employer. Is it not? The employer has gone and filed an application for domestic cooking gas. The domestic cooking gas bill will also be issued in the name of employer. So bill is in the name of employer and payment is made by employer. In this case, the perquisite is taxable only for specified employees. In this case, the perquisite is taxable only for specified employees. Okay, bill is in the name of employer and payment is made by employer. It is taxable only for specified employees, and those specified employees we have already seen, who is a director or who is a major shareholder in my organization, or whose income under the head salary exceeds 50,000. Second case, the bill was issued in the name of employee and payment was made by employer. See, in that case, it is a personal obligation of employee being met by the employer. Is it not? Bill is issued in the name of employee means the employee is under an obligation to pay that, but that obligation is paid by the employer. In that case, whether this employee is specified or non-specified, that will be taxable in his hands. So if any personal obligations of the employee is taken care of by the employer, then that perquisite will be taxable in the hands of all employees, whether that employee is specified or non-specified. So these are the two cases where the perquisite will be taxable. We are identifying in whose hands the perquisite will be taxable. We are seeing in whose name the bill is issued. If bill is issued in the name of employer and payment is made by the employer, the perquisite is taxable only for specified employees. On the other hand, if the bill is in the name of employee and payment is made by the employer, then the perquisite is taxable in the hands of all employees, whether that employee falls in the specified category or not. Now let us see what is value of perquisite. As I told you yesterday, like in the previous session, the common sense logic behind valuation of perquisite is identifying how much is the expenditure of the employer, how much has the employer spent for the employee. That will be the personal benefit in most of the cases. Okay, that will be the perquisite value in most of the cases. So let us take a case where I'm working with BSNL. the standard example. I'm working with BSNL, and the BSNL persons, the employer, he is paying the electricity bill to the electricity board, to the state electricity board. The employer is paying electricity bill. In other words, payment is made by the employer to an outside agency. Or else I have taken a cooking gas connection. The employer is paying electricity, the cooking gas bill to Indian Oil Corporation or Bharat Petroleum. All right. So the employer is making payment to an outside agency. When the employer is making payment to an outside agency, the value of perquisite is the amount paid by the employer. Amount which has been paid by the employer is the value of perquisite. Now, there can be a second case where the employer is providing all these from his own sources. Like, I'm working in an electricity board. The employee is working in the electricity board. Employee is paying, employee is getting free electricity from his own employer. Or the employee is working in Bharat Petroleum, and the employee is getting cooking gas from Bharat Petroleum itself. From own sources, employer is providing electricity or water or gas supply. In that case, the expenditure of the employer is the manufacturing cost. So identify how much units have been supplied to the employee, what is the manufacturing cost to the employer for those units, and that will be value of perquisite in hands of employee. But in both the cases, we can claim deduction for the amount which is recovered from the employee. Like, employer is incurring an expenditure of 12,000 towards electricity bill. The employer recovers 1,000 rupees from the employee. Then only 11,000 is to be considered as perquisite in the hands of employee. Okay. So that was regarding gas, electricity, or water supply. So there are two cases. In certain cases that will be taxed only in the hands of specified employees, and bill is in the name of employer and payment is made by employer. On the other hand, bill is in the name of employee and payment is made by employer. It will be taxable for all employees, whether specified or non-specified. And the value of perquisite is depending upon to whom the employer is making payment. If he is making payment to outside agency, it is the amount paid. If he is supplying from own sources, then it will be the manufacturing cost. In either case, there is a deduction for amount recovered from employee. Okay. Now, the next perquisite is regarding domestic servants. The next perquisite is regarding domestic servant. At least there's a deduction from it. Domestic servant, again, the rule is almost same as which we had discussed in the case of electricity and water supply. That is, if appointment is made by employer, the servant is appointed by the employer and payment is made by the employer, the perquisite is taxable only for specified employees. On the other hand, if it is appointed by the employee and payment is made by employer, the perquisite is taxable for all employees, whether that employee is specified or non-specified. Value of perquisite is the common sense logic, that is amount paid by employer minus amount recovered from employee. In this case, we can discuss another point as well. There is one extra point that is to be considered. This is like, there is a rent-free accommodation which is owned by the employer. It's a rent-free accommodation owned by the employer. It's not hired by the employer. Okay, is that clear? It's a rent-free accommodation which is owned by the employer, and the employer is appointing gardener there. Employer has also appointed a gardener, and he's incurring expenditure for maintenance of garden. Okay. In this case, the Income Tax Act says that there is no perquisite which is to be valued in respect of the gardener which has been appointed by the employer. No perquisite regarding gardener is to be taxed in the hands of employee. And the logic behind what they have explained is, since it is a house which is owned by the employer, it is employer's requirement that he has to keep that house neat and tidy. It's employer's requirement. It's not for the sake of employee that he is maintaining a garden, he is keeping it clean. Okay, it's employer's house. So he himself wants, employer himself wants that house to be kept clean. He is not maintaining a garden because the employee is staying there. He will be keeping that house clean, he'll be maintaining that garden even if the employee is not staying. So the expenditure which is incurred by the employer for the gardener is not for the sake of employee, it's for himself. It's not for that employee that he is spending money. He is spending money for himself. For the same reason, there is no perquisite in the hands of employee if a gardener is appointed by the employer for a house which is owned by the employer. Okay, so that was regarding domestic servants. That was regarding domestic servants. Now let us come to leave travel concession. Leave travel concession, that is LTC. Leave travel concession. Leave travel concession means the employee is going for a pleasure trip. Okay, he is taking leave and he is traveling, which means he is going for a pleasure trip. And the traveling expenditure which is required for the pleasure trip is taken care of by the employer. Employer, he meets all expenditure on travel, personal travel of the employee. There is an exemption when you get that LTC from the employer. The amount which is actually spent will be allowed as exempt. Amount given by the employer, if it is spent by the employee on that travel, then he can claim exemption for the amount which is spent. Now, there is no fund in a solo trip. That is what the Income Tax Act says. There is no fund for a solo trip. So you may take with you your spouse, your children, your dependent parents, dependent brothers and sisters. Okay. Employer, whatever employer spends for all these persons, that will be exempt. So you may go with your family, and family, it's not just spouse and children. It also includes dependent parents, dependent brothers, and dependent sisters. See, spouse and children need not be dependent upon the employee. Spouse and children need not be dependent upon the employee, but parents, brothers, and sisters shall be dependent upon employee if he wants to claim exemption. So that is it. Exemption can be given, but exemption can be given only for the perquisite, only if the amount is actually spent. All right. If you do not spend the amount which is given by the employer, then that LTC which is received will be fully taxable as perquisite. Now, there is another point here, that is exemption is given only for maximum 2 children. Maximum 2 children, but multiple birth after first single child is treated as one. What do you mean by that? Multiple birth after first single child is treated as one. Let us see, what does that mean? An employee, he has the first child, he has a first child. First child is aged 5. And in the next delivery, they were twins. Next delivery, they were twins, aged 3. So altogether, he has 3 children now. Can claim exemption under section 10(5) in respect of amount spent for all these 3 children, because that is what I told, multiple birth after first child. After first child, in the second delivery, there are more than 1 child. That is what we call as multiple birth. All those will be treated as 1 child. So the twins will be treated as only 1 child, and hence you can claim exemption for all 3 children. If there is a reverse that happens, like First, he has twins, aged 5. Then there is a single child. Then there is a boy. Let's take a boy. There is a single child, aged 3. First, he has twins and then he has boy. In this case, exemption can be claimed only for 2 children. Exemption can be claimed only for 2 children. So I hope you have understood the meaning of the term. I hope you have understood the meaning of the term. What does it mean? Multiple birth after first single child is treated as 1. Then there is another point that was introduced from I think 1989 onwards. 1989 onwards, a block of 4 calendar years was taken as a single block. Okay, we group 4 calendar years to form a single block. 4 calendar years are grouped together to form a single block. So let us take 89 to 93, 1989, 90, 91, 92. Sorry, it shall be 92. 89 to 92. 4 years. We'll keep on grouping it. 93 to 96. 1997 to 2000. 2001 to 2004. 2005 to 2008. 2009 to 2012. 2013 to 2016, 2017 to 2020, 2021 to 2024, and 2025 to 2028. I think the correct classification is correct. No, here we have gone wrong. 93, 94, 95, 96, correct. 97, 98, 99, 2000, 5 to 8, 9 to 12, 3 plus 3, 7 plus 3, 1 plus 3. Okay. Now, what does the Act say? You may go for a pleasure trip every year. You may go for a pleasure trip every year. Your employer is giving you leave travel concession every year. You can keep on going for pleasure trip every year. No problem. But Income Tax Act will give exemption only for 2 journeys. Only for 2 journeys performed in a block of 4 calendar years. So between 1989 and 92, you can claim exemption only for 2 journeys. Even though you have gone for 4 journeys, every year 1 journey, employer keeps on giving you LTC every year, but Income Tax Act gives you exemption only for 2 journeys. The other 2 journeys, the amount which you have received towards leave travel, that will be fully taxable. Exemption is given only for 2 journeys performed in a block of 4 calendar years. Okay, performed in a block of 4 calendar years. Now, another thing. Let us take the recent block, that is 2021-24. 2021-24. I did not go for any journey in 2021-24. Which means I have not availed any concession. I have not availed any concession. So I have not enjoyed any exemption as well. I have not enjoyed any exemption during this block. During 2021 to 24, I have not enjoyed any exemption because I had not availed any concession during 2021-24. Maybe some reason my children were in 10th standard, 12th standard, they were busy preparing for their entrance exams. So I did not go for any journey during the period 2021 to 24, which means I have a credit of 2 exemptions. Is it not? I have 2 exemptions to my credit in 2021-24. Those exemptions in your credit can be carried forward to the next block. Can be carried forward to the next block, but only 1 exemption can be carried forward. Even if you have not taken any journey, even if you have not enjoyed any exemption in 2021-24, or even if you have enjoyed only 1 exemption in 2021-24, only 1 exemption can be carried forward to the next block. Carry forward is given only for 1 exemption. Carry forward is given only for 1 exemption. No matter whether you have enjoyed any exemption in 21-24 or whether you have enjoyed only 1 exemption in 21-24. Always carry forward benefit is for 1 exemption. which means 2025-28 altogether we can enjoy 3 exemptions. 2 for that block and 1 that was carried forward from the earlier block. But keep in mind, the exemption that is carried forward, that is brought forward from the last block, it has to be enjoyed in the first calendar year of the next block. It has to be enjoyed in the first calendar year of next block. Okay, so 2025, you have to enjoy 1 exemption. That brought forward benefit of 21-24 has to be enjoyed in 2025 itself. If you don't go for any journey, in 2025, again, in that block, you get only 2. Okay, so I repeat, in a block of 4 calendar years, starting from 1989, in a block of 4 calendar years, starting from 1989, a person can enjoy only 2 exemptions. In a block of 4 calendar years, a person can enjoy only 2 exemptions. If for any reason a person has not enjoyed those 2 exemptions, 1 exemption can be carried forward to the next block. 1 exemption. Carry forward benefit is given only for 1 journey. 1 exemption can be carried forward to the next block, which means in the next block, he can enjoy 3 exemptions. But again, that exemption that was brought forward from the last year, it has to be enjoyed in the first calendar year of next block, which means he has to enjoy it in 2025 itself. 2025. If he does not enjoy in 2025, then in that block, again, he can claim only 2 exemptions. Okay, so that was regarding leave travel concession. So point number 7 is over. Now let us come to point number 8. Point number 8. Any life insurance policy, that is any assurance, any protection on the life of the employee, for securing that protection on the life of employee, employer is paying premium. Employer is paying life insurance premium on the life of the employee. That life insurance premium which is paid by the employer is taxable. Life insurance premium paid by the employer is taxable, but there are exceptions. In the following cases, the contributions which is paid by the employer for protecting the life of the employee is not taxable. One is employer's contribution to RPF up to 12% of salary. We have discussed elsewhere that employee can contribute up to 12% of employee's salary, and there is no perquisite taxable. There is an exemption up to 12%. So we continue with the same logic here as well. Employer contributes to RPF and the amount contributed does not exceed 12%, then the entire amount contributed to RPF is exempt. There is no taxation in that case. Second case is employer contributes to 3 different funds: superannuation fund, pension fund, and RPF. All added together, if that exceeds 7,50,000, it is taxable. If it doesn't exceed 7,50,000, nothing is taxable. If that goes above 7,50,000, the excess is taxable. Okay, so there is an exemption up to 7,50,000. Third point, there is a group insurance scheme. An employer has taken an insurance policy, but the insurance policy is not taken for a single person. It's taken for a group of employees in his organization. So the premium which he has paid, it cannot be identified to a single person. Premium which he has paid is for a group of persons. Okay, premium paid is for a group. It's not for a single person. All right. So it is not to be taxed in the hands of a single person. Any employee expenditure which the employer spends for a group is not taxed in the hands of individual employees. Then there are the ESI schemes, the state insurance schemes. The contribution that is to be made to the ESI scheme is compulsory. So the employer making any contribution to ESI scheme, that is also fully exempt. Fidelity guarantee scheme. Fidelity guarantee schemes are usually taken by the employers for securing himself, the employer himself, and not for securing the employee. So again, fidelity guarantee scheme is exempt. Medical insurance premium paid, health insurance premium paid by the employer on the health of the employee, that is also exempt. So these are the 6 items that are exempt in the hands of employee, even though employer is spending money for the employee. One is RPF contribution up to 12%, 3 schemes total 7,50,000, group insurance scheme, ESI scheme, fidelity scheme, and the last one is medical insurance premium paid. Point number 9, we are coming to perquisite in respect of education. Perquisite in respect of education. Educational facility, it can be either given to the employee or it may be given to family members of the employee. Education facility may be given either to the employee or to the family members of employee. Okay. If the employee is provided some training facility or education facility by the employer, we all know that the objective of this providing training facility to the employee is not for the personal benefit of the employee, but in order to help the employee to work better in the organization. If at all the employer provides some training facility to the employee, the ultimate objective behind that training facility is to help the employee to work better in the organization. In other words, the employee is not gaining anything personally. There is no personal benefit enjoyed by the employee, so there is no perquisite in the hands of the employee. See, the word perquisite, if it has to be taxed, any perquisite which is given by the employer is to be taxed. There should be some personal benefit to the employee. In the absence of personal benefit, there is no perquisite valuation. So that is the first case. If any perquisite is given to the employee, training facility of the employee, perquisite in the form of educational facility to the employee, it's not taxable. Now we come to family members of the employees. Family members. The education facility is being given to the family members. When we come to family members, the facility may be given either in kind or in cash. Educational perquisites may be given in cash. See, if it is given as a fixed cash amount, we call it allowance, educational allowance. And we have already seen that when a fixed educational allowance is given, it is exempt up under section 1014 up to 100 per month per child up to a maximum of 2 children. So fixed education allowance given to the employees' family members, we have already discussed while we were discussing exemption in respect of allowances. Now we come to educational facility. It's not given in cash. It's not given in cash. Instead, what is happening there? It's a facility which is given. Let us see what is happening there. The facility which is given may be of 2 types. One is the employer pays tuition fees of employees. He goes to the education institution, the school where the employees' children are studying, and the employer makes payment of tuition fees. This can be again in 2 ways. Either it can be direct payment or it can be reimbursement. Perquisites can always be direct payment or reimbursement. So the employer directly goes to school and pays the tuition fee, or the employee first pays it and then employer reimburses to the employee. So it's an outside school. That is, it's not a school which is run by the employer. It's not a school which is run by the employer. Employer is paying Delhi public school. Okay, employees' children is studying in Delhi public school, and you are an employee of BSNL, so there is no connection there. It's not employer's school. Employer is paying school fees. That entire amount of expenditure incurred by the employer will be taxed, but of course, we can claim deduction for amount recovered from employee. So the value of perquisite is amount paid by employer minus amount recovered from employee. Okay. Now, the next case is, it's a school which is run by the employer. It's a school which is run and maintained by the employer. In other words, this employer's own school. In that case, again, the perquisite has to be divided into two types. First case is the education facilities given to employees' children, or the education facilities given to any other family member of the employee. Education facilities given to employees' children, or the education facilities given to any other family member, that is employees' brothers, employees' sister, or employees' grandchildren are studying in a school which is run by the employer. Again, let us apply that logic. What is the employee gain here? Had he put his children in some other school, he will have to pay tuition fee to that school. He is saving that much amount of tuition fee. So the value of perquisite is cost of education in a similar school in the same locality. Okay, cost of education in a similar school in the same locality minus amount recovered from employee. Okay, if he has to, that children is put in some other school in the same locality, the educational fees there would have been 50,000 in a year, 50,000 in a year. Since the children are studying in employer's school, employee is not required to pay that 50,000. So he's saving that 50,000, and 50,000 is a benefit in the hands of employee. That is the value of perquisite. So whether it is family member or children, value of perquisite is the same. Cost of education in a similar school in the same locality minus amount recovered from the employee. The amount he's saving, how much amount the employee is saving, that amount is the value of perquisite. That is his benefit. But there is one additional point I have to talk about. If it is employees' children, if it is employees' children, there is one additional point which I have to talk about. That additional point is that if the cost of education in a similar school in the same locality does not exceed 1,000 per month, nominal amount, the value of perquisite, that might be the logic. If the cost of education in a similar school is very small in the sense it is less than 1,000 per month, then there is no need to charge it as a perquisite. Okay, but if it exceeds 1,000 per month, the entire cost is taxed as perquisite. I'll give you an example. Two children of an employee is studying in employer's school. Two children. Let us take Arati and Ashok. These are two children of employees. Cost of education in a similar school in the same locality is here 900. Okay. If we put Arati in another school in the same locality, you might be paying 900 per month. Of course, 900 per month. And cost of education of Ashok in another school would have been 1,200 per month. Okay. Amount recovered from employee is here 100 per month, and here it is 200 per month. Let us find out what is value of perquisite in both these cases. In the case of Arati, there is no perquisite. Because the amount of educational cost in a similar school in the same locality does not exceed 1,000. That is only a very small amount. So just ignore it. So there is no perquisite for Arati. Whereas for Ashok, the value of perquisite will be 1,200 minus 200. That is cost of education in a similar school minus amount recovered. Okay. How about if the employee's brother is studying? And cost of education is 900 per month. And amount recovered is 100 per month. In that case, value will be 900 minus 100. If it is employee's brother, because that exemption of 1,000 per month is applicable only for employees' children. I told you there is no need to charge perquisite if cost of education in a similar school is less than 1,000. It does not exceed 1,000 per month. But that benefit is applicable only for employees' children. If any other family member of the employee is studying in the employer's school, then the entire amount, the entire cost of education in the similar locality, in a similar institution, the same locality, is to be taxed. entire cost, whether it is less than 1,000 or more than 1,000. Okay, so these are the three cases. Arathi and Ashok are employees' children. Arathi 900 per month does not exceed 1,000, so no perquisite. Ashok, it exceeds 1,000 per month, so cost of education minus amount recovered. Brother, that 1,000 per month exemption is not applicable. That is applicable only for employees' children. So 900 minus 100 will be taxable. These are the three cases. The education facility is over. Now let us come to the next case. Next case is regarding interest-free loan or loan at concessional rate. Interest-free loan or loan at concessional rate. That is the next perquisite. Interest-free loan or loan at concessional rate. Many a times, employer might provide loan to employees. Many a times. And the loan which is given to the employee might be at a rate lower than the bank rate. Lower than the bank rate. Let us take again an example. You have taken a housing loan from your employer. Okay, you have taken a housing loan from your employer. The employer has offered that loan at a rate of only 2%. He charges an interest of only 2% for the housing loan. Okay, 2%. If you had taken this loan from bank, let us take State Bank of India. The rate of interest which you have to pay to bank would be 8%. That is the rate which is charged by State Bank of India for a similar loan, for housing loan. But your employer is offering this loan at 2%. So what is the benefit which we are enjoying? 6%? Is it not? 6% is the rate of perquisite. And you apply that rate of 6% on the loan outstanding. On the loan outstanding. And 6% on loan outstanding is the value of perquisite. If you had taken this loan from bank, you are paying 8% interest. But since that is your employer, you are paying only 2%, which means your benefit is 6%, and 6% is to be applied on the loan outstanding. If the loan outstanding keeps on changing every month, then it has to be applied on loan outstanding at the end of each month. The rate has to be applied. The perquisite benefit rate has to be applied on the loan outstanding at the end of each month. Yes, let us again take an example. My loan outstanding on 1st April was okay. 1st of April, loan outstanding is 6 lakh. Every month on 5th, I repay 12,000 towards principal. I repay 12,000 towards principal portion of the loan every month. Every month on 5th, I repay 12,000 towards principal. Okay. Employer's interest rate is %. SBI rate is, we have to compare that with SBI. Okay. SBI rate is 8%. What is the perquisite rate? What is benefit? Benefit which we are enjoying is 6%. That is a benefit. And this benefit of 6% has to be applied on the outstanding balance of loan every month then. So let us see how much is my perquisite for 30th April 23. 30th April 23, 30th April 2023, my principal amount outstanding is not 6 lakh because on 5th April 23, I have repaid 12,000. So when it comes to 30th April, my loan outstanding is 6 lakh minus 12,000, which is equal to 5 lakh 88,000. Okay. Then value of perquisite will be 5 lakh 88,000 into 6%, but 6% is per annum for a year. So for 1 month, it will be divided by 12. This is a perquisite value for April month. Okay. April month, this is a perquisite value. 5,88,000. Identify what is the month end balance. Apply that. But the rate which we have fixed here, the 2% and the 8% rates, that is the rate per annum. So per month, the rate will be 6% divided by 12. Again on 31st May, the amount outstanding will be 5,88,000 minus 12,000, which is equal to 5,76,000. 5,76,000 into 6% divided by 12 again. And so on up to March. This is how we calculate the value of perquisite. So what we are finding out here is, first of all, find out what is the rate charged by State Bank of India. What is the rate of interest which your employer has charged? The difference is the benefit, and the benefit has to be applied on the month-end balances, month-end closing balances. So perquisite is over. Regarding interest-free loan, that is over. But again, there are exceptions. In certain cases, perquisite is exempt. In certain cases, perquisite is exempt. Even though you are enjoying benefit from your employer, there is nothing to be taxed. Which are the two perquisites that are exempt? First perquisite is, loan is given for medical treatment of Rule 3A disease. Rule 3A disease mean they are life-threatening diseases like cancer, AIDS, kidney failure, some sort of heart diseases. So if you are giving if the loan is given, employer is giving loan for treatment of certain heart diseases, then there is no value of perquisite. Okay, the loan is given for medical treatment of certain specific diseases, and specific diseases are listed under Rule 3A. Rule 3A means they are the life-threatening diseases. Life-threatening diseases like cancer, AIDS, and all. There is no perquisite in respect of this medical treatment loan it is given. Second, the amount of loan is very small. Very small in the sense the amount which is fixed here is 20,000. Total amount of loan outstanding is does not exceed 20,000. Then also there is no perquisite. Okay, so there are two cases where there is no perquisite charge in respect of interest-free loan. One is the loan is taken for medical treatment of Rule 3A disease, and the second one is amount of loan does not exceed 20,000. These are two different cases, two separate cases. See, for medical treatment of Rule 3A disease, however huge the amount is, there is no perquisite. Other loans, if they do not exceed 20,000, there is no perquisite. Amount of loan does not exceed 20,000, there is no perquisite. All right. So that perquisite is over. Now let us come to 11th perquisite. Case 11. The employer is providing some asset for the use of employee. Employer is providing certain asset for the use of employee. The ownership of the asset is not transferred. Only the possession is given to the employee. Employee can keep those assets with himself. All right. Earlier, when we were discussing rent-free accommodation, we had mentioned that where furniture is provided to the employee, the value of perquisite will be. Any asset belonging to the employer is given to the employee. The value of perquisite is. How do we calculate the value of perquisite? We calculate depreciation. Is it not? So if it is owned by the employer, the value of perquisite is depreciation, and depreciation is assumed to be 10% per annum on cost. On the other hand, if the asset is taken on rent, the value of perquisite will be higher charges. Okay, it's the same rule, same as the case of furniture. Any asset, whether it is furniture or some other, the value of perquisite is same, 10% per annum on cost if it is owned by the employer, or higher charges if the asset is taken on rent by the employer. But there are two cases again where there is no perquisite, exemption. Certain perquisites which are given for use are exempt. What are those assets which are given for the use of employee is exempt? One is computers, laptop, telephone, or mobile phone. Computers, laptop, telephone, or mobile phone. See, When an employer provides a computer to the employee and the employee uses that computer for both official purpose and personal purpose. Point number one, we have to bifurcate how much amount is used for, we have to segregate the amount which is used for personal purpose, the browsing which he has done for personal activity, personal purpose, the films which he has watched using this computer. We have to segregate official and into personal. Might be able to segregate that, but that is time consuming and the amount that may be involved there will be too small. The amount of personal benefit which we may arrive after making a lot of calculations, that will be very much a small amount. That might be the reason why there is no perquisite where a computer or laptop is given for use of employee. Similarly, employer has given a mobile phone. You are making personal calls as well as official calls from this mobile phone. All right. You are making official calls as well as personal calls. We can look into the call history. We can identify how much calls he has made for personal purposes and all. But even then, a lot of time is involved in segregating all that and identifying the amount involved. And the amount involved will be too small. So just ignore that. It's not worthy spending too much amount of time to identify very small amount of taxable perquisite. So just ignore when the employer has provided computers or laptop or telephone or mobile phone. That is first case. Second case where a perquisite is exempt is, employer has himself used that asset for more than 10 years. An asset which is very old is given to the employee. Very old means employer himself has used it for 10 years and then he is passing on that asset to the employee. In that case, there is no perquisite. Because over the period of 10 years, the asset would have been fully depreciated, is it not? 10% per annum is a depreciation we are assuming here. So over a period of 10 years, asset is fully depreciated. There is no value remaining for the asset as in the 11th year, as at the beginning of the 11th year. So there is no perquisite to be taxed in this case. Okay. 12 cases, sale of asset. Sale. Point number 11 was the ownership was not transferred to the employee. Point number 12, the employer is selling this asset to employee and definitely he'll be selling at a value which is lower than market value. Then only there is a point in calculating the perquisite. So let us see that case. Let's take an example. An employer has purchased a motor car for 5 lakh and the motor car is purchased on 1/9/2020. Okay, 1/9/2020. This motor car is sold to employee on, let's take a date. Sold to employee on 1st July 2023 for rupees 1 lakh. Okay. Employer has purchased this asset on 1st September 2020 for 5 lakh and then he is selling this asset to employee on 1/7/23 for 1 lakh. We have to identify whether there is any perquisite involved. In order to identify the perquisite, what we have to find out is the present value of the motor car. Let us just take an assumption. If it is 2,25,000, present value of the motor car is 2,25,000 and the asset worth 2,25,000 is sold to employee for 1 lakh. Asset worth 2,25,000, the employee is getting that asset for 1 lakh. What is his benefit? 1,25,000. So how do we arrive at the present value? Present value is equal to cost minus depreciation. Cost minus depreciation is the present value and that minus sale value is the value of perquisite. Okay. Identify the cost, deduct depreciation and arrive at the present value and then deduct the sale value. So this is how we find out market value. Cost minus depreciation minus sale value. But how do we calculate depreciation? Rate of depreciation is different for different types of asset. Rate of depreciation is different for different types of asset. First of all, we calculate depreciation only for completed year. Only for completed year. Depreciation for part of the year is ignored. And the rate of depreciation is for electronic items or computers which are fast depreciating. It is 50% per annum on written down value method. Motor car, it is 20% per annum on written down value method, and any other asset, it is 10% per annum on cost. Okay, this is how we charge depreciation. While calculating the value of perquisite, this is a depreciation which we have to apply. Electronic items, fast depreciating 50%, motor car 20%, other assets 10%. So let us come to this. Cost is 5 lakh. That was purchased on 1st September 20. So we have to calculate depreciation up to, first we have to calculate depreciation up to 1st September 2021. It is 5 lakh into 20%, right? 5 lakh into 20% would come to 1 lakh. Balance is 4 lakh. Again, calculate depreciation for the next year. Depreciation up to 1/9/2022. That is again 4 lakh into 20%, 80,000. So 3 lakh 20. Is it not? Now, do we need to calculate depreciation up to 1st September 23? Do we need to calculate depreciation up to 1st September 23? No, no, because asset was not used up to 1st September 23. There is no another completed year. Asset was sold by the employer on 1st July 23. The asset is not used up to 1st September 23. 1st September 23 will make another one completed year. So there is no more depreciation required. Okay. This was cost on 1st September 20. We calculated depreciation up to 21. We calculated depreciation up to 22 September. The asset is not used up to September 23. So there is no depreciation. So this is the market value now. This is the value of asset now. Less sale value. Sale value is 1 lakh. So balance value of perquisite is 2,20,000. This is how we arrive at value of perquisite. So we have discussed case number 12 as well. Now let us come to case number 13. Case number 13. Case number 13 is value of perquisite in respect of medical facility. Employer is providing medical facility to the employee. What is the value of perquisite? In this case, the value of perquisite has to be classified into two different cases. One is in India and the other one is outside India. Okay, the medical facility is provided in India or the medical facility is provided outside India. All right. If the medical facility is provided in India, how do we find out the value of perquisite? In India, that is, employer is incurring expenditure on medical treatment of employee or any of his family members. And the family member, the definition is same as an LPC, meaning you can take your spouse, your children, dependent parents, dependent brothers, and dependent sisters. So the value of perquisite is in India. In India itself, the expenditure might be incurred in government hospital. It might be a hospital which is owned by the employer. It might be a hospital which is approved by CIT, and it is any other hospital. Okay, there are 4 cases. And in these 4 cases, we have to identify certain exemptions. We have to learn some exemptions. And medical expenditure which is incurred in any other hospital other than these 4 will be fully taxable. Okay, for these types of 4 hospitals, we are providing some exemptions. For these 4 hospitals, there are certain exemptions. Any medical perquisite other than these will be fully taxable. So which all hospitals, which all diseases we can claim exemption? First case is the employer has spent money for medical expenditure treatment of an employee in a government hospital. Okay, any disease, the employee is going to government hospital, he spends money there, employer gives him, employer reimburses the amount. Any disease, that is fully exempt. Then employer's hospital, same rule, any disease, fully exempt. Employer is spending money on medical treatment of employee in his own hospital, employer's own hospital, that is fully exempt. Hospital approved by CID. There are a lot of conditions if your hospital has to be applied by CID. One of the conditions, I will tell you, one of the conditions, this is a huge hospital in the sense, there are 100 beds in this hospital. There are an IP facility in this hospital is for 100 beds. Okay, 100 persons can be admitted in this hospital at a time. So that is what we call one of the conditions to get this hospital approved by CID. So many other conditions as well. Anyway, the medical treatment is incurred in somewhat a big hospital, a huge hospital. All right. Then exemption will be given only for treatment of Rule 3A disease. Rule 3A disease. Rule 3A disease we have already seen, those life-threatening disease. So the employee is suffering from cancer. He is going to a huge hospital, a private hospital, but a big one, which has at least 100 beds. The employer is reimbursing the entire expenditure. It is fully exempt. Okay. And the last case is, you are going to any hospital for COVID-19 treatment. It can be a huge one, a small clinic, a nursing home, any hospital you go for COVID-19 treatment and you have incurred expenditure, which is reimbursed by the employer, that is fully exempt. So these are the 4 cases in India where you can claim exemption, meaning any other case that is fully taxable. Government hospital, any disease, fully exempt. Employer's hospital, any disease, fully exempt. Hospital approved by CID only for Rule 3A disease, fully exempt. And any other hospital only for COVID-19 treatment, fully exempt. So let us take a case where you have malaria. Okay, malaria is not a life-threatening disease, or you have measles. Okay, measles is again some sort of fever. It's again not a life-threatening disease. Rule 3 disease means life-threatening, cancer, AIDS, birth, death is almost certain. But malaria, you have malaria or you have pneumonia. These are all not life-threatening. You can take antibiotics treatment, and so that's not a life-threatening disease. Or in other words, it is not specified under Rule 3A. That disease is not there under Rule 3A. So for malaria treatment, you went to a huge hospital which is approved by CID. It's not a government hospital, it's not employer's hospital. You went to a hospital which is approved by CID. You incurred an expenditure of 50,000 for your treatment. The entire amount of 50,000 was reimbursed by the employer, but the amount of 50,000 is fully taxable. Do you get that? Amount of 50,000 is fully taxable. So this is regarding medical treatment in India. Medical treatment in India. Now we come to medical treatment outside India. Okay, medical treatment outside India. What is the rule when the expenditure is incurred outside India? When you're going outside India, you have to spend money not only on your medical treatment, but also for stay abroad and also for traveling. So in this case, if you're going abroad for medical treatment, employer gives you 3 monies. One is medical treatment, second is stay abroad, third one is traveling expenditure. We can claim exemption for all these 3 which is given by the employer, but again subject to certain restrictions and conditions. Let us see what are those conditions and restrictions. Okay. Of these 3, that is stay abroad, medical expenditure and traveling expenditure, of these 3, just think about those expenditure which are incurred in foreign currency, which may be incurred in foreign currency. Which are the 2 types of expenditure? Out of these 3, that is medical expenditure, stay abroad and traveling. Which are the 2 expenditures that may be possibly spent in foreign currency? Yes, stay abroad and medical expenditure will be spent in foreign currency, right? So the exemption is applicable. The applicable exemption is as per the limit which is prescribed by Reserve Bank of India. you have to make an application to Reserve Bank of India, and the amount which is mentioned by Reserve Bank of India in their approval letter, that will be the amount of exemption. So income tax has no say in this matter. So just in order to remember, identify the logic. Which are the expenses that might be incurred in foreign currency? That will be stay abroad and medical expenditure. When foreign currency comes, Reserve Bank of India interferes. Okay. When foreign currency comes, Reserve Bank of India interferes. So the exemption will be as per the limit which is mentioned by Reserve Bank of India. Whereas traveling expenditure will be exempt. Traveling expenditure which is given by the employer will be exempt if total income excluding travel reimbursement receipt does not exceed 2 lakh. Okay. Find out how much is your total income just before including traveling reimbursement. Just before including traveling reimbursement, identify how much is your total income. If that total income does not exceed 2 lakh, entire amount of traveling received is exempt. If that total income exceeds 2 lakh, entire amount of traveling received will be fully taxable. Did you get that? I'll again give you an example for that. Let's take 2 employees in an organization, Mr. A and Mr. B. Okay. Excluding all these medical treatment expenditure, their salary or total income is 1,80,000 and 1,90,000. Now, employer is incurring expenditure on their medical treatment abroad. So employer is giving traveling expenditure. Employer is giving stay abroad is being reimbursed. Employer is also reimbursing the medical treatment expenditure. Let us assume that the medical expenditure reimbursed was in both the cases, okay? For both A and B, medical expenditure which was reimbursed was 85,000, but Reserve Bank of India permitted only 75,000. Reserve Bank of India permitted only 75,000. RBI felt that this 85,000 is a huge amount. There was no need to spend that much money. This medical treatment costs only 75,000 abroad. So the medical expenditure which was permitted by Reserve Bank of India is only 75. So that is the amount which is exempt. So we have to tax in both the cases 1,90,000. Okay. Another case which is reimbursed by the employer is stay abroad. When you go abroad, you cannot directly get admitted to the hospital the same day. 1 or 2 days you stayed in a hotel, and the third day you were admitted to the hospital. So stay abroad again, for stay in a hotel abroad, 1,20,000 was the amount which was incurred. But RBI again permitted only 1,15,000. So amount taxable in respect of this is 5,000. Amount taxable in respect of this is 5,000. Okay. Now you are getting one more item, that is traveling expenditure. Traveling amount is also reimbursed by the employer. Traveling is also reimbursed. Amount of traveling which is given by the employer is, let's take 1,40,000 is the traveling amount which is received from the employer. My question is whether this traveling reimbursement received is taxable. Whether the traveling reimbursement received is taxable. Whether 1,40,000 is to be included in total income of Mr. A and total income of Mr. B. Let us read the line once again. What is the rule which is given? Traveling reimbursement received is exempt if total income excluding traveling reimbursement does not exceed 2 lakh. See, at this stage, before adding 1,40,000, identify your total income. If that does not exceed 2 lakh, traveling is exempt. If that exceeds 2 lakh, traveling is taxable. There is no exemption, which means traveling is taxable. So let us add total income of this person at this point. At this point, how much is total income? Here it is 1,95,000 and here it is 2,05,000. Here it is 1,95,000, here it is 2,05,000. In the case of Mr. A, the amount of total income at this stage does not exceed 2 lakh. Hence, traveling reimbursement received is exempt. But for Mr. B, it exceeds 2 lakh and hence there is no exemption, which means traveling reimbursement received from employer will be fully taxable. So this is how their gross total income would stand. This is their gross total income. At this stage, while we add the traveling reimbursement, this will be their total income. Here it will be 1,95,000 and here it will be 2,05,000 plus 1,40,000, 3,45,000. So this is a rule regarding traveling. Just before adding traveling reimbursement, identify total income. If that is less than 2 lakh, nothing is taxable. If that is more than 2 lakh, entire amount is taxable. Now let us come to point number 14. Point number 14 is point number 14, free transport given to transport employees. Free transport given to transport employees. Free transport given to transport employees means the employee is working in a transport undertaking and employer's transport facility. Employer is providing some transport facility to the public. That same transport facility is also used by the employee at a concessional rate or absolutely at free of cost. Okay, employer is providing some transport facility to the public. The same transport facility is also used by the employee, but employee uses it at a concessional rate or at free of cost. All right. So, what is the rule? The transport facility which is given to employees of airlines and employees of railways is fully exempt. Free transport facility given to employees of airlines and employees of railways is fully exempt. And in any other case, let us take an employee who is working in the State Road Transport Corporation. Okay, in the State Road Transport Corporation. Or it can be any other private operator as well, not just the public transport, that is about the public sector company. It can be a private transporter as well. So, an employee is working in a State Road Transport Corporation. Employer permits that employee to use that vehicle. The vehicle is going to Bangalore, Chennai to Bangalore. Chennai to Bangalore, the employee is traveling free in employer's facility, employer's transport facility. What will be the value of perquisite? Common sense rule. Identify what is the value at which value of Chennai, Bangalore bus ticket. That bus ticket is being enjoyed free by the employee. So value, market value minus value of perquisite is market value minus amount recovered from employee. Nothing to be explained extra. All right. Then, lunch or refreshment, that is next perquisite. Employee is providing lunch or refreshment to the employer is providing lunch or refreshment to the employee. Lunch which is provided, it is exempt up to 50 per meal, which means employer is providing a lunch worth 120. 120 is the value of the lunch. 120 is the expenditure which is incurred by the employer, and that lunch is being provided free to the employee. Value of perquisite will be 70 rupees. 120 minus 50, 70 rupees. 70 into number of working days. 70 into number of working days. 200 working days in a year. 70 into 20 will be taxable. But there are again exemptions. There are no perquisite in two cases. One, food is provided in a remote area. Food is provided in a remote area, and tea or snacks which is provided in any area, that is fully exempt. Lunch is taxable, tea or snack is exempt. Third case, that is point number 16. Point number 16. Next case. Traveling or touring accommodation. Traveling or touring accommodation. See, earlier we had discussed about LTC. LTC was you were going for a pleasure trip and the employer has taken care of your traveling expenditure. Now you are going for a pleasure trip and the employer is taking care of your accommodation in that place. The amount which you are spending by way of accommodation, that is, the employer is paying all the money. Employer has a guest house in Ooty. Okay, employer owns a guest house in Ooty and the employee is staying there. Most of the organizations, public sector organizations, they provide guest houses at various tourist centers. So employees may be enjoying those accommodations and all the guest houses which are located at various centers. Employee can stay in that. So how do we identify the value of perquisite in such a case? This has to be divided into two cases. This perquisite has to be divided into two categories. The first category is that the policy of the employer is like, any employee of my organization can stay in my guest house. Any employee, whether he belongs to the higher level management or the middle level management or the lower level management. See, even a sub-staff in my organization, like a peon in my organization can enjoy this benefit. That is my policy. That is the employer's policy. The facility is uniformly given to all employees. Okay, facility is uniformly given to all employees. In that case, value of perquisite is expenditure of the employer minus amount recovered from employee. When you are staying in that employer's accommodation for, let's take, you are staying in employer's accommodation for 3 days. And whatever is the expenditure which the employer has incurred upon you for the 3 days, like the electricity charges, the housekeeping charges, the laundry charges, the food which was provided for these 3 days. These are the expenditure which are incurred by the employer, that minus amount, if any, recovered from the employee. Second category in this is the employer policy is like, this facility is not uniformly given to all employees, meaning peons or clerks in my organization, they cannot enjoy this guest house. Only those persons who have reached the officer level. If it is a bank, like State Bank of India, we will have officers at various levels. There will be officers, there will be clerical staff, there will be the sub-staff or the peon. So, SBI, suppose SBI says that peons and clerks, they cannot enjoy our facility. Only those persons who have reached the officer level can enjoy the facility, which means the facility is not uniformly given to all employees. In this case, value of perquisite is cost of facility in a similar hotel in the same locality. If you had stayed in the hotel in the next street, having the same standard as that of this guest house, how much would be the amount which you will have paid? You are saving that money. That amount minus amount recovered from employee. That is point number 16. Point number 17, the employer is giving gift or voucher or token to the employee. Employer is giving gift to the employee. Okay, gift. This gift may be in cash or in kind. Okay, employer is giving a gift check. Employer is giving a gift check. That is a gift which is convertible into money. Okay, so any gift which is received in cash, that is fully taxable. It is fully taxable. Gift in kind is exempt up to 5,000. Gift in kind is exempt up to 5,000. Regarding this gift in kind, there are two interpretations, but let me explain those interpretations as well. Gift in kind. Gift in kind is exempt up to 5,000. That is the rule. Exempt up to 5,000. Now, what are the two possible interpretations that are possible here? What are the two possible interpretations here? Interpretations. Let me explain that with an example. Employer gifted me with a watch worth 4,000. With a watch worth 4,000. It is fully exempt because amount of gift does not exceed 5,000. This is fully exempt. Another case, he gifted with me with a watch worth 8,000. Worth 8,000. In this case, there are two interpretations. In this case, there are two interpretations. What are the two interpretations? First one is only 3,000 is taxable. Only 3,000 is taxable because there is an exemption up to 5,000. Second interpretation, is exemption is only up to 5,000. So the amount crosses 5,000, the entire 8,000 is taxable. You may follow, while you answer for the examination, you may follow any of these two interpretations. Okay, you may follow any of these two interpretations. You complete your answer following one interpretation. Let us take, we chose this option. We chose 3,000. You add 3,000 to your total income, find out total income, tax liability, whatever you are required to find out. Okay, complete your answer. Complete your answer taking 3,000. Then give a note. Give a note that there is an alternate interpretation that 8,000 is taxable. In that case, answer will change. Salary will increase by 5,000. That difference. Just mention that by a statement, by a single line. That's enough. You can take either of these interpretations. Okay. If a watch worth 8,000 is given, there are two interpretations. Only amount in excess of 5,000 is taxable, or the entire amount is taxable. While doing for exam, you can choose any of these interpretations. Complete your answer by choosing one interpretation and then give that alternate interpretation by a single statement. That's enough. You need not do in two separate columns. Okay. Now, that was regarding gift. Now let us come to credit card. Employee has a credit card, but all expenditure which the employee spends upon that credit card is spent by the employer. That is reimbursed by the employer. Value of purpose is a common sense rule. Expenditure of employer minus amount used for official purpose minus amount recovered from employee, because only amount used for personal purposes to be treated as perquisite. So if the employer has incurred any official expenditure by using the credit card, and the employee has incurred personal expenditure by using the credit card, and employer is paying him money, that is not to be taxed. So deduct that official part, only the personal part is to be taxed. Okay. Then club expenditure. Club expenditure, that is, he is a member in some health club, or maybe the Lions Club, Rotary Club, such clubs, the employee is a member, and whatever expenditure the employee is incurring in those clubs, that is being met by the employer. Value of perquisites, again, the common logic. Expenditure of employer minus amount used for official purpose minus amount recovered from employee. Okay. Next case is sweat equity shares. Sweat equity shares means employees of an organization are offered the company's share at a value which is lower than market value. In many cases, it will be lower than face value. Companies' shares are offered to employees at a value lower than market value. In this case, the value of perquisites. Value of perquisites. Identify what is the market value of the share on the date the employee is allotted those shares. Employee exercises the option to take those shares minus amount recovered from employee. Market value of the share minus amount recovered from employee, and market value will be opening value of average of opening value and closing balance. That again is a common logic. Identify, see, the shares today are worth 800. My company shares are today worth 800. I'm getting those shares at 200 rupees. So I'm enjoying a benefit of 600 rupees. That will be the value of perquisite. Shares worth 800 today. I'm getting those shares from my employer at 200. My benefit is 600 rupees. Now point number 21. Any other benefit other than what we have discussed so far. If the employer provides to employee, then there is no separate rule which has been specifically mentioned. Just apply the logic. Expenditure to the employer minus amount recovered from employee will give the value of perquisite. Anything other than these 20. Anything other than these 20 perquisite, if it is given to the employee, value of perquisite is expenditure of the employer minus amount recovered from employee. Okay. Now there is one more perquisite which we have to discuss here, that is regarding motor car. One more perquisite which we have to discuss here, that is regarding motor car. Draw a chart in respect of that. Motor car. When we talk about a motor car, this motor car might be, okay, this motor car might be owned by the employer. Owned also include hired, okay. It may be owned by the employer, or it can also be hired by the employer, or it may be owned by employee. It might be owned by employee. Oh, okay. Then again, this car, the petrol expenses are being taken care of by the employer. Petrol expenses are also paid by employer. Okay. Or it can be like the petrol expenses are paid by employee. Petrol expenses are paid by employee. So it's a car owned by employer. Expenditure is also made by employer. Car is owned by employer. Expenditure is also made by employer. Or it's a car which is owned by employer, but expenses, diesel or the petrol or the repairs, running, maintenance, everything is met by employee. Okay. Again, this car again I have to divide into 3 categories. Car owned by employer, expenditure met by employer. Again, it has to be divided into 3 categories. What are those 3 categories? What are those 3 categories? Car is used only for official purpose. Okay. Car is used only for official purpose. Car is used only for personal purpose. Car is used partly official, partly personal. Do you understand? The car is used only for official purpose, only for personal purpose, partly official, partly personal. But if the car is used only for official purpose, what will be our answer? There is no perquisite. No perquisite. If the car is used only for official purpose, there is no perquisite. So we have to divide now this only into 2 categories. What are the 2 categories? Car is used only for personal purpose and partly official, partly personal. We have to divide each of these into 2 categories each. Whatever is the case, the car is used only for official purpose, there is no perquisite. If the car is used only for official purpose, there is no perquisite. Whatever is the case, whether it is owned by the employer, owned by the employee, hired by the employer, hired by the employee, whatever. So we have to divide each car now into car is used fully for personal, partly for official, and partly for personal. If the car is used fully for personal purpose, it's an employer's car, expenditure is made by employer, car is used fully for personal purpose. Value of perquisite is the logic, common sense, actual expenditure of the employer. Whatever employer expenses, Whatever the employer spends is for my personal benefit. Is not. Isn't not. Whatever the employer spends is for my personal benefit. Is it not? So the entire amount spent by the employer is my personal value. And what all can be the amount which is spent by the employer? What all can be the amount spent by the employer? It's employer's car. It's employer's car used by me. So there is depreciation, and depreciation will be 10% per annum or higher charges. 10% per annum or higher charges. That is point number 1, which we have to tax. Okay. Point number B, we have to tax the running expense. Running expense. So these are the 2 possible expense which will be incurred by the employer. If it is a car owned by the employer and expense met by the employer. Car is owned by the employer means I am using the car, and hence the employer's expenditure is by way of depreciation. Okay, which is 10% per annum. And if it is a car which is hired by the employer, it will be the higher charges. Understood. Then there is a running expense on diesel and petrol that will also be fully taxable. If the car is partly official and partly personal, that is, the employee is not able to tell how much this car is used for personal purpose, how much this car is used for official purpose. If the employee is not able to tell that, then the department takes an assumption. Okay, this much is the value of perquisite. This much is the value of perquisite, and assumption which they have taken is 1,800 per month. If it is a small car means, how do you define a small car? Small car means we measure it by engine capacity. That is, engine capacity of the car is less than or equal to 1,200 cc. Engine capacity of the car. We explain that with in relation to engine capacity. Okay. I'll show you that limit. How do we define a small car? If it is a small car, small value of perquisite. If it is a small car, value of perquisite will be small. Okay. But if it is a big car, value of perquisite will be higher. And how do we say that it is a small car or big car? It is on the basis of engine capacity, and engine capacity is 1,600 cc. 1,600 cc, or it is also explained in terms of liters. 1,000 cc is 1 liter, so 1.6 liters or 1.6 liters. Okay, this is how we define a small car or a big car. Less than 1,600 cc car is given to the employee, then the value of perquisite is 1,800 per month. If it is a big car, it will be 2,400 per month. That is more than 1,600 cc or 1.6 liters. All these data will be given in the question. You need not bother about the engine capacity of the various cars and all. The question will specifically mention what is the engine capacity of the car. Okay, so this is the value. Up to 1.6 liters, it is 1,800. Above 1.6 liters, it is 2,400 per month. Along with this, if you are given a driver as well, a chauffeur as well, for driver, we add additional 900 per month. Additional 900 per month if a driver is also given. So this is regarding value of motor car. So I repeat, car is owned by the employer or car is hired by the employer. Expenditure is also met by the employer. Car is used fully for personal purpose. Entire expenditure of employer is value of perquisite. And entire expenditure of employer is 10% per annum or higher charges, depending upon whether this car is owned or hired. Plus, there is running expense. If it is partly official, partly personal, that is, the employee himself is not able to tell how much the car is used for official purpose and how much is the car is used for personal purpose, then the Income Tax Act takes an assumption. Assumption is value of perquisite is 1,800 per month. If it is a small car, 2,400 per month. If it is a big car, and small and big based on engine capacity, 1,600 cc or 1.6 liters. Now we come to the next case. Car is owned by the employer. Expenditure is met by employee. Okay. Car is owned by the employer. Expenditure is met by employee. That again, we have to divide into two categories. That again, we have to divide into two categories. What are the two categories? Car is used fully for personal, only for personal, and partly. Partly. If it is fully for personal, then there is no need for learning anything by heart. It's a common sense rule. Expenditure of employer. Expenditure of employer. Here, employer's expenditure will be only higher charges or depreciation because running expenses are met by employee. Do you understand? Running expenses are met by employee. So employer's expenditure is only depreciation or higher charges. And partly official, partly personal. Here again, we take an exemption. Here again, we take an exemption as to the engine capacity of the motor car and all. We have taken exemption as to how much is the value of perquisite. But in this case, the exemption amount which we take will be lower than 1,800 or 2,500. Why? Why? The expenditure is met by employee. So the perquisite has to be charged only in respect of that owning part. Only because the employer is the owner. So the value of perquisite will be lower than in the earlier case. And the value of perquisite in this case is value of perquisite in this case is if it is a small car, it is 600. And if it is a big car, if it is 900. Plus, of course, if a driver is also provided, additional 900 per month for the driver. Okay. So this part is over. We can always compare and learn. If both the expenditure is incurred by the employer and car is also owned by the employer, perquisite value will be higher. But if the expense is met by employee, then the perquisite value will be lower. All right. Now we come to this part. Car is owned by employee. Car is owned by employee and expenditure is met by employee. Car is owned by employee and expenditure is met by employee. There is no perquisite. What is the point in calculating the perquisite? Perquisite is to be calculated only if something is given by the employer. Here, car is owned by the employee and expenditure is also met by the employee. So there is no perquisite. We need to calculate perquisite only if expense is met by employer. Only if expense is met by employer. Expenses met by employer. Okay. And this again, we have to divide into two types. Expenses met by employer, we have to again divide this into two types. What are the two types? Car is used fully for personal and car is used partly official, partly personal. Partly official, partly personal. Fully for personal means there is no need to calculate any value of perquisite. In other words, there is no need to remember anything. Actual expenditure of the employee. And actual expenditure of the employee will be running expense. Actual expenditure of the employer will be only running expense because car is owned by the employee. So only running expenses will be taken in this case. Partly official, partly private, the value of perquisite is. If it is partly official and partly private, the value of perquisite is partly official and partly private. Then the value of perquisite will be employer's expenditure minus official purpose minus amount recovered from employee. And one more thing, if you are not able to identify how much is official purpose amount, how much is amount spent for official purpose, if the employee has no details about that, then again income tax takes an assumption. Income tax assumes that amount spent for official purposes, if there is no data in the data with you, then amount spent for official purposes assumed to be 1,800 per month or 2,400 per month, depending upon engine capacity of the car. Big car, 2,400 is spent for official purpose. Small car, 1,800 is spent for official purpose. Okay. So this is regarding motor car valuation. But these are the most important cases because these are the cases where we have to learn something, we have to remember something by heart. So these are the cases which might be asked from examination point of view. These are the cases where we remember something. Okay, so partly official, partly private. Then we take an assumption, and that assumption part is 1,800 or 2,400, depending upon whether it is a big car or small car. One more thing. In these two cases, where we take an assumption as the value of perquisite, where and some figure fixed by income tax department is taken as value of perquisite, some figure fixed by income tax act is taken as value of perquisite, or income tax rule rather is taken as value of perquisite. In these two cases, please keep in mind that there is no deduction for amount recovered from employee. There is no deduction for amount recovered from employee. Where you take some amount as value of perquisite. See, an amount which is fixed by Income Tax Act is taken as perquisite in this case, is it not? 1,800 is the value of perquisite that is fixed by the department. So from that 1,800 or 2,400 or 600 or 900, whatever is the case may be, there is no deduction, there is no further deduction for any amount recovered from employee. And this is the only case. This is only perquisite valuation where there is no deduction for amount recovered from employee. Where in any other case, whenever we value a perquisite, the last step is deduct amount recovered from employee. Any other case, the last step is deduct amount recovered from employee. But these are the two cases where there is no deduction for amount recovered from employee. Okay, car is owned by employer, expenditure met by employer or met by employee, and we take a fixed amount as value of perquisite. When we take a fixed amount, there is no further deduction. Perquisite valuation is over. All perquisites have been valued. Okay, so now let us go back to the format for computation of salary. Format for computation of salary. We have to take three items: income from salary, allowance, and perquisite, and we have added all these together. We have added all these items together. Now we have reached that gross salary. Salary, allowance, and perquisite added together. We have now identified what is gross salary. From gross, we have to claim deductions. Deductions are given under section 16. There are three deductions. Let us see what are those deductions. There are three deductions. Deductions are deduction, that is a uniform deduction, and standard deduction maximum is 50,000. Okay, if your gross salary is only 40,000, your standard deduction would only be 40,000. You cannot claim a standard deduction of 50,000 in that case. Then there is a deduction for entertainment allowance. Entertainment allowance deduction is given only for government employees. Okay, only for government employees, and the deduction is calculated in 3 steps. The deduction is calculated in 3 steps. Calculate these 3 steps. Identify whichever is lower, and the lowest of these will be allowed as deduction. What are the 3 steps? First of all, 5,000 per annum. Okay. Percentage of basic salary. Remember, 20% of basic salary. And what is entertainment allowance actually received. Compare these 3 items, whichever is least will be the amount of deduction. So that is a deduction for entertainment allowance. Okay, 5,000 per annum, 20% of basic salary actually received. Then the third step is professional tax paid. You have to pay a certain amount as professional tax to the local authority, to the municipality. Okay, the employees have to pay a certain amount as of professional tax to the municipality. So when they pay that professional tax, it is allowed as deduction. But in some cases, professional tax will be paid by the employer on behalf of employee. Professional tax is paid by employer. That is an obligation of the employer met by employee. So this professional tax paid by employer will be first included in gross salary. Okay, first include it in salary and then come down standard deduction. After that, give deduction. So if the professional tax is paid by employer, you have to make two adjustments. What are the two adjustments? First, include it in salary and then claim it as deduction. If it is paid by the employee, then there is only one adjustment that is to be made. That is, you can claim it as deduction. Okay, I repeat. Professional tax is paid by employer, two adjustment. First include in salary, then claim deduction. If it is paid by the employee, then only give deduction. Okay. So that way, we have deducted three items and we will arrive at final income from salary. Okay, let me clarify one more thing in this regard. Generally, in most of the cases, while we were calculating exemptions for salary or when we were valuing something, rent-free accommodation, we apply certain percentages on salary, is it not? Like if it is gratuity, we would say 15 by 26 into last run salary. If it is leave salary, we would again say amount standing to credit as per income tax rule into average salary. So everything is applied on salary. So we had, again, RPF 12% of salary. So we had defined that salary for the purpose of calculating these exemptions and allowances or deductions were the common definition. And what was the common definition? Common definition is basic salary plus DA provided by terms of employment plus commission paid on turnover. Commission paid on percentage of turnover achieved by the employee. In most of the cases, this was the common definition. Most of the cases. Okay, this is the common definition which we follow. Basic salary plus DA provided by terms of employment plus commission paid on percentage of turnover. I repeat, this is the definition which we follow while we are calculating exemptions or deductions or making valuations, etc. But there are three exceptions. There are three exceptions. In three cases, we follow a different definition of salary for this purpose. While calculating exemption, we don't follow this common definition. Three exceptions. One is in the case of employee covered by Gratuity Act. Employee covered by Gratuity Act. There, the definition of salary is basic salary plus DA. DA always. Basic salary plus DA. DA always, whether or not forming part of retirement and we don't take commission. That is the first case where we follow a separate definition. Second is the case where we value rent-free accommodation. When we value rent-free accommodation, when we calculate salary for the purpose of rent-free accommodation, all monetary payments are to be added. All monetary payments. All monetary payments. And I think I had also given you 4 items which are not to be added, which are to be excluded. DA, not forming part of retirement benefits, exempt portion of allowance, value of perquisites, RPF contribution, etc. So that was the second case where we follow a different definition. The third case is the point which we have just discussed, entertainment allowance. Entertainment allowance. Entertainment allowance, when we calculate deduction, we apply 20% of basic salary. Only PA, no commission, nothing. So these are the 3 cases where we don't follow the common definition. Okay, where we don't follow the common definition. Gratuity, others we follow common definition. Leave salary we follow common definition. VRS we follow common definition. Every other place when we are calculating exemptions we follow the common definition. Basic salary plus DA provided by terms of employment plus commission paid on percentage. These are the 3 cases where we follow a different definition for salary. Covered by Gratuity Act, basic salary plus DA. Then rent-free accommodation, all monetary payments, and entertainment allowance, 20% of basic salary. Okay. So we have completed all provisions regarding salary. We'll take a short break of 30 minutes. And after that, we will do one problem on how to compute total salary. regime. About 10 lakh, we have a tax rate of 30% and so on. Then there is a surcharge, rebate, everything, cess, etc. So this is the old slab, or we call this as the old regime. Okay. From assessment year 24-25 onwards, assessment year 2024-25 onwards, that is when you're writing exam for your May 2024 and after that, what the act says that you are in default regime. The default regime is the new regime or the 115 BSc slab. If nothing is mentioned in the question, you have to compute total income and tax liability as per the default regime. That is as per 115 BSc slab. Okay, the question is silent. You have to calculate, but automatically by default, you are paying tax in 115 BSc. If you don't want to pay tax under 115 BSc, you have to opt out. You have to take a choice and go to the old regime. Otherwise, you are in new regime. That is a default regime. So let us also see what is the difference in new regime. What is the slab as per regime? What are the differences if we go to new regime? Okay. As per the new regime, there is a change in tax slab. There is a change in slab rate. The new regime is like this. This is a new slab rate, okay, under the default regime. Up to 3 lakh, there is no tax. Whether you are a senior citizen or a very senior citizen, irrespective of age, your tax rate is, your basic exemption limit is 3 lakh, irrespective of your age. Then the slab increases by 3 lakh each. That is 3 to 6 lakh, 6 to 9 lakh, 9 to 12 lakh, 12 lakh to 15 lakh, and above 15 lakh. That is how the slab is designed. Every 3 lakh, 3 lakh, 3 lakh. Up to 3 lakh, 3 to 6, 6 to 9, 9 to 12, 12 to 15. And how are the percentages? Increase it by 5%. 5, 10, 15, 20, and then jump to 30. There is no 25 slab rate. Okay? 5, 10, 15, 20, and 30. So this is the slab as per the default regime. So if nothing is mentioned in the question, we have to compute tax liability as per this default regime. Clear? And another thing is, once you choose 115 BSc, we see that tax rates are lower in 115 BSc. Tax rates are lower in 115 BSc. That is, tax rates are lower in the sense, if it is the old regime, we know once the income crosses 10 lakh, you have to pay taxes at the rate of 20%. Sorry, the income crosses 5 lakh. If the income crosses 5 lakh, you have to pay taxes at the rate of 20%. Is it not? But here, 20% would come only when your income is above 12 lakh. Only if your income is above 2 lakh, you need to pay 20% tax. But old regime, once income is above 5 lakh, you have to pay 20% tax. So undoubtedly, this is the slab which has lower rates of taxes, lower amount of taxes. If you calculate as per this scheme, your tax amount will be lower. But the thing is, if you are choosing 115 BS, if you are opting for, if you don't go out of 115 BS, if you don't opt out of 115 BSc, you cannot claim a lot of deductions. If you are in 115 BSc, tax amount will be lower, but your income might be higher. Income might be higher because there are no exemptions. There are fewer exemptions. Let me put it that way. There are fewer exemptions if you go for 115 BSc. All those exemptions which we discussed earlier when we were talking about the chapter salary, some of them might not be available if you choose 115 BSc or if you are in 115 BSc. So which are those exemptions or deductions that are not possible in 115 BSc? Let us compare that from the point of view of salary. Okay, from the point of view of salary, let us see what are those items that are not allowed. Items that are not allowed if you are in 115 BSc. One, LTC exemption. LTC exemption, you have to forgo. Forget about 115 BSc if you are paying tax under the scheme. HRA, no. No exemption for HRA. 1014 special allowance, all are not available. but I will give you four. Four exemptions you can claim in 115 BSc. Four. Which are the four that can be claimed in 115 BSc? Everything that is related to traveling. See, traveling allowance, daily allowance, conveyance allowance, transport allowance. Everything that is related to travel, you can claim in 115 BSc. There is no children education allowance, there is no exemption. Uniform allowance, there is no exemption. Academic research allowance, there is no exemption. Tribal area allowance, there is no exemption. Only those four items which are related to travel. Try to remember in that way. Only those items which are related to travel, like traveling, conveyance, daily, and transport are available in 115 BSc. Then Section 16, you cannot claim deduction for entertainment allowance and professional tax. Standard deduction is possible. Standard deduction is possible even in 115 BSc, but entertainment allowance and professional tax are not possible if you are in 115 BSc. So let us recollect, the slab rate is lower, I understand. Tax amount might be lower, but your income might be higher because there are fewer exemptions in 115 BSc. Those exemptions which are not possible in 115 BSc are LTC, HRA, 1014, only four availed, only four allowable. Then Section 16, entertainment allowance and professional tax. So in many cases, what happens is for exam, you will be required to make a comparative study, which is better. 115 BSc is better or the other scheme is better. Okay. So let's try doing one problem. And there is also one problem from the material, ICAI study material, which I would like to work out, because that is a new type of question that has been introduced in this new syllabus. See, new syllabus, most of the questions are relating to tax planning, whether you have to be in 115 BSc or whether it is better to opt out of 115 BSc. So most of the questions they ask from tax planning aspect. Anyway, for the time being, we'll do essay 22. Suggest answer 22. Let me do this by assessment year 24. There is a rent-free accommodation also which is provided. So I think we'll have to do in two different columns. Okay, we'll have to do in two different columns. Up to August, there is one calculation. From September, there is another calculation and so on. And another thing is compute income from salary, assuming he does not opt for provisions of 115 BSc. What will be in his income if he is in 115 BSc? So we have to answer both. Okay, 115 BSc and not. We'll make a comparison. He is a sales manager in PQR Limited. During financial year 23-24, he has received the following towards his salary, allowance, and perquisite. Basic salary, dearness allowance, bonus, 14% of basic salary and DA contributed to Provident Fund, and his employer makes the same amount. Traveling allowance, research allowance, children education allowance, 800 per month per child for 3 children, 2 sons and 1 daughter. There is an accommodation which is provided in Hyderabad. Population is not given. It's owned by the employer. We'll take the maximum population. In the absence of any information, we will take the maximum population. All right. Reimbursement of medical expenses in his treatment in private hospital. Medical allowance of 15,000. Company has paid a medical insurance policy. So we'll first do on the assumption that he has opted out of 115 BSc. Opted out of 115 BSc. That is my first calculation. Opted out. Opted out of 115 BSc. Okay. That is, let me explain. This is old regime. Old regime. Old regime. He is paying tax in the old regime. So there is no 115 BSc here. And then we will just identify what is the difference between old and new regime. Just we'll make a comparison. Basic salary. Basic salary is December it is 85,000 and from December it is 2,000 there is an increase. So 85,000 into 9. 85,000 into 9 plus 87,000 into 2. How much would that come to? 85,000 into 9 9,39,000. This is basic salary. Okay, that is shown. See, when you're trying the when you're doing a question on salary, first write basic salary and DA, and then you go in the order of the question, one below the other. You answer in the order of the question. Second item is dearness allowance. This 40% of basic salary. So 9,39,000 into 40 divided by 100. Dearness allowances 9,39,000 into 40%. Okay, dearness allowance. Bonus, it is 1 month basic pay based on salary drawn during January month. Bonus is given in January. So that will be given on the basis of salary for January. Salary for January was, basic pay for January was 87,000. So this will be your bonus. Understood? This will be your bonus. Then he contributes 14% of his basic salary and DA towards RPF. Employee contributes 14%. Employer also contributes 14%. Employee and employer contributes 14%. So we have to see whether that is in excess of 12%. So what we'll write first is employer's contribution to RPF. Employer's contribution to RPF. This is equal to employer contributes 14%. So 14% of what? 9,39,000 plus 3,75,600. Nine lakh 39 plus 3,75,000 into 14%. Is it not? 1/4. 14% is the amount contributed to RPF. Okay. We know that when an employer contributes towards RPF, it is exempt up to 12%. Less exempt up to 12%. 12%. 12% of what? Again, 12% of basic salary plus DA provided by terms of employment. What is the question saying? Yes, it is forming part of retirement benefits. So we have to take 12% of, that is exempt up to 12%. 12% of basic salary plus DA into 12 by 100. That is a taxable amount. Okay. This is a taxable amount in respect of employer's contribution towards RPF. All right. Employer's contribution to RPF. It is exempt up to 12%. So only the balance 2% is taxed. Fifth item is traveling allowance. And it is given that 5,000 per month is given towards duty tours. So I assume that it has been fully spent because this is given towards two. And I should have spent it then. So that duty tours, the word which they have used is that is given towards duty tours. You would have fully spent it on duty tours. That's actually on the basis of an assumption. So I take an assumption that it is fully spent. Traveling allowance. You have to give a note to that effect. Okay. It is 5,000 per month. So 60,000 less exempt under 1014. Exempt under 1014, 60,000. So taxable amount is 0. So you'll be giving a note. What is that note? The note regarding traveling allowance. Okay, you have to write that. It is assumed that traveling allowance is fully spent towards official purpose. So there is nothing taxable in respect of traveling allowance. Research and training allowance. Research and training allowance, it is given 3,000 per month, but no information is given regarding the amount spent. No information is given regarding the amount spent. In the earlier case, they had said that it is spent towards duty tours. So I assume it is fully spent, but here nothing is mentioned. So research and training allowance will be fully taxable. Research and training allowance will be fully taxable. Research and training allowances, 3,000 per month. That is 36,000. Again, less exempt under 1014 is 0. fully taxable. Okay, fully taxable. What further? Children education allowance. Children education allowance. It is 600 per month per child. So let us see how much is received. Children education allowance, how much is received? Amount received is 600 into 3 into 12. 600 into 3 into 12. And of that, how much is exempt? Exempt is 2,400. 100 into 2 into 12. 100 into 2 into 12. Okay, 19,200 is exempt. Then there is an accommodation. We will do that towards the end of the question. We'll wait for that. We'll do other items as well. Next item is reimbursement of medical expense. Reimbursement of medical expense. It is not in government hospital. It is not in employer's hospital. It is in a private hospital. So that is fully taxable. 15,000 is fully taxable. It's a private hospital. And even if it is in a private hospital, if it had been towards COVID-19, this would have been fully exempt. In the absence of information, I assume that it is not towards COVID-19. Medical allowance, 1,500. Medical allowance. There is no exemption for medical allowance. Remember, allowances, there are only 3 exemptions. 1013A, 1014, and special foreign allowance. 1013A HRA, 1014 special allowances, those traveling, children education, tribal area, etc. And 107 foreign allowance given by government. Medical allowance is fully taxable. Medical allowance is 1,500 into 12, fully taxable. And last item is company has paid medical policy on health. Health insurance premium paid by employer is exempt perquisite. Health insurance premium paid by employer is exempt perquisite. Health insurance premium paid by employer, that is exempt. Now we have to calculate one more item, that is rent-free accommodation. Rent-free accommodation. We'll go to working note. We'll go to working. Okay. Working note, as I explained yesterday, we have to calculate we have to make 2 different calculations. One up to August and the other is from September onwards. Okay. One is from August and other is from September onwards. Let me make the calculation here itself so that it is easy for me to write all the figures. Okay. So I'll make 2 different calculations. Since the basic salary itself changes during this period of 12 months, I have to make all these calculations for 2 months, 2 periods separately. So one is up to August, up to 31st August, and here it is from 1st September. From 1st September. If the salary had been the same throughout the year, if the salary had been the same throughout the year, all 12 months, I will add all those 12 months salary and then we'll bifurcate into 5 by 12 and 7 by 12. But here the basic salary itself changes. Basic salary itself changes. Up to December, you had one salary, and from September onwards, you had another salary. So as a result of this, we have to make separate calculations. Basic salary up to August is 85,000 into 5. Okay. Here it is 85,000 into September, October, November, December, 4 plus 87,000 into 3. Okay. You cannot divide 9,39,000 into 5 by 12 and 7 by 12. Your answer will be wrong. We have to take salary for that specific month. If salary is the same throughout, the calculation will be the same whether you take the entire amount into 5 by 12 or 7 by 12. But here the salary itself changes. So we have to make different calculations. Okay. So this is basic salary. Now let me apply the formula. 85,000 into 4 plus 87,000 into 3. Okay. from, yes, here it should be 87,000 into 3, right? Yes. Here it is 87,000 into 3. Now it's correct. So this is basic salary. 85,000 into 9 plus 87,000 into 3. I have bifurcated as 4,25,000 and 6,01,000. DA, there is no change. So basic salary into 40%. Basic salary into 40%. Basic salary into 40% is the DA. Bonus, you are getting bonus in the month of January. You are getting bonus in the month of January. So 87,000 can be taken only for the September. The bonus becomes due only in January. Okay, bonus is not due from April to December. Bonus the employer gives only in January. So that comes only to the second part. There is no bonus received in the first part. That is why I told you we have to make calculations separately for both the periods. Employer's contribution to RPF is not to be taken because that doesn't fall under the definition of salary. 4 items we don't take when we value house. One is DA not provided by terms of employment. Second is exempt portion of allowance. Third one is perquisites. No perquisites to be taken for valuing house. And fourth one is employer's contribution to RPF. So 28,728 we don't take for valuing the house. While calculating value of house, we don't take 28,728. Traveling allowance is fully exempt, so that is not to be taken. Research allowance we have to take because that is a taxable allowance. Research allowance will again bifurcate. 36,000 that we can bifurcate directly. 36,000 into 5 by 12. Because research allowance is the same throughout the year. There is no change in research allowance. 36,000 into 5 by 12 and 36,000 into 7 by 12. Okay. Children education allowance again, we can bifurcate because the amount is same throughout the year. Children education allowance. It is 19,200 into 5 by 12 and 19,200 into 7 by 12. 19,200 into 5 by 12 and 19,200 into 7 by 12. All right. Then reimbursement of medical expense being a perquisite, that is not to be taken. Reimbursement of medical expense is a perquisite and that is not to be taken. Medical allowance we have to consider. Medical allowance. Medical allowance again 15,000 into 5 by 12 and 15,000 into 7 by 12. $15,000 into 5 by 12 and 15,000 into 7 by 12. Over. Health insurance premium paid, that is exempt. So we need not take. Now let us add salary for both the periods together. Okay. I assume that that's the maximum population. Maximum population. Assumed maximum population. Population is not given in the question since it is Hyderabad. I'm not sure about the actual population there, but I take an assumption that there is a maximum population there. So if it is a maximum population up to 31st August, the rule is we have to take 15% of salary. And from September, it is only 10% of salary. Okay. So value of houses, 6,24,250 into 15 by 100 and 9,69,350 into 10 by 100. We'll ignore the decimals. So total value of houses is equal to total value of house is equal to 1,90,573. Along with this, value of furniture. Value of furniture. But furniture is provided only from October. Okay, furniture is provided only from October, and the value of furniture provided is 2 lakh. Value of furniture provided is 2 lakh. So 2 lakh into 10 by 100 into 6 by 12, it's 10% per annum. Per annum, when any furniture, any asset is given for use to the employee, it's 10% per annum. So 2 lakh into 10% into 6 by 12. 20,000 to 6 by 12, that comes to 10,000. So this is total value finally of furnished accommodation. Value of furnished accommodation. Value of furnished accommodation is the total value 200,572. This is how we calculate. The salary itself changes. Salary itself changes during the year. You have to find out each and every item separately. Otherwise, if all the figures remain constant throughout the year, calculate for the whole year, and the whole can be divided into 5 by 12 and 7 by 12. So this is value of furnished accommodation. 200,573. We will add all those together and we'll find out how much is this gross salary. How much is this gross salary? Then from that, less deductions under section 16. Deduction under section 16. Below that, 1A, standard deduction. No information about professional tax and entertainment allowance. Standard deduction, 50,000. So finally, this is income from salary. Income from salary. This is how we calculate. This is how we calculate. All right. So this is as per old scheme. That is, you have opted out of 115 BSc. Now let us see what is the difference if he is in 115 BSc. If he is in 115 BSc, what is the difference? This is when we assume that he has opted out of 115 BSc. So I will go to the next table. I'll go to the next table. Employee is in 115 BSc. Let me just copy this down. Copy this down. And we will see what are the differences. We will make necessary changes as we go down the table. Okay, let me just copy this down. So here's in 115 BSc, what will be changes? Let's just make a comparison. Okay, he is in 115 BSc. Basic salary, no change. DA, no change. Bonus, no change. Employer's contribution to RPF, no change. Traveling allowance, you can claim exemption both in 115 BSc and otherwise. Okay, research and training allowance, no change. Here is one change. There is no reduction for children education allowance. There is no deduction for children education allowance. If we are going for 115 BSc, then reimbursement of medical expense fully taxable. There is no change. Medical allowance fully taxable. But since that children education allowance changes, there will be corresponding change in the value of house as well. Value of house. See, basic salary, no change. DA, no change. Bonus, no change. Research, no change. Children education allowance, now you have to calculate on the basis of 21,600. 21,600 into 5 by 12, 21,600 into 7 by 12. Okay. When 15% and 10%, add these together. 00863 is the answer. So not much of a change. Earlier it was 2,00573. Now it is 2,00863. No change, no much of a change. Maybe a few hundreds. Your answer varies by a few hundreds. 17,93,591, 17 lakh 9, no, thousands, is it? Yeah. Change. 2,00573. Yes. When you come to the final answer, there will be difference by 3,000 because here there is no exemption for 115 years. Here there is no exemption for children education allowance and 115 BSc. So even the house value changes by only a few hundreds. 2,057 and 2,00800, 300 rupees. While come to the total answer, there will be a difference of around 2,700 because there is no exemption for children education allowance of 2,400. Okay. So that will be the final answer if you are in 115 BSc. Basic salary, no change. DA, no change. Employer's contribution bonus, no change. Traveling allowance, fully exempt. Research, no change. Children education allowance changes. The final answer will be 17,93,591. I thought we will do one more question, and that one more question we are doing is from ICAI study material. ICAI study material, take module 2. That's a new type of question which we haven't seen so far. Module 2, Section 5, Chapter 9. Module 2, Section 5, Chapter 9. Page number 9.28. Page number 9.28. Illustration 2. Illustration 2. We'll read the question. Mr. Kavin is entitled to a salary of 40,000 per month. He is given an option by the employer either to take HRA or to take a rent-free accommodation. Okay, there are two options for you. Either you may take HRA or a rent-free accommodation. If it is a rent-free accommodation, that will be owned by the employer. HRA amount is 7,000. And when you are receiving HRA, you will have to pay a rent of 6,000 at New Delhi. Advise Kadam, which is beneficial for him, to avail HRA or rent-free accommodation. And this advice shall be given on the basis of your cash in hand, the net cash which you may have with you if you go for HRA or rent-free accommodation. And he has shifted out of default tax regime. So he's not in default tax regime. He's not in 115 BSc. He is under the old regime. Old regime means he can claim exemption for HRA. Okay, that is the assumptions, which is better. We'll first see what happens if he's getting HRA. What happens if he's getting HRA? We'll do HRA first, and then we'll go for rent-free accommodation. Okay. So there are only two items which the employer receives from the employee receives from the employer. One is basic salary, and the other is HRA. No further items which are received. So it's a pretty simple question. There are no much calculations required. So the first one is he is accepting HRA. He's telling his employer he wants something in cash. He doesn't want it quarters. He does not want it quarters. What will be the answer in this case? Basic salary. Basic salary is 48,000, right? 4,000 is it? No, 40,000 per month. 40,000 per month will come to 4,80,000 then. 4,80,000. 40,000 into 12. 40,000 into 12. See, when you are writing the amounts and all, mention here it is in rupees. These are all basics, but that makes sense. When you are making calculations, whenever you are writing some amounts, make a heading as to it is in rupees. Now he is also getting HRA. HRA he receives 7,000 per month. 7,000 into 12. 7,000 into 12 will come to 84,000. Now let us calculate the exemptions. Let's exempt under 1013A. Exempt under 1013A. What are the exemptions for HRA? First exemption is, since he is in Delhi, the first calculation is 50% of salary. 50% salary is there only 4,80,000, so 2,40,000. Okay. Second calculation is rent minus 10% of salary. Rent minus 10% of salary. How much is rent paid by him? Rent paid by him is 6,000 per month. 6,000 per month is rent paid. So 72,000 minus 48,000. 72,000 minus 48,000. 4,80,000 into 10%. 48,000 will come to 24,000. Last calculation is actual HRA received. Actual HRA received. Actual HRA received is 84,000. The least of these will be exempt. So the amount exempt is 24,000. Is it not? 24,000 is exempt. So taxable HRA will be 60,000. Right? Gross salary is Gross salary is 5,40,000 plus deduction under section 16. Standard deduction. 1A. Wherever possible, try to mention the sections. Standard deduction 50,000. So finally, income from salary is ₹4,90,000. Okay, income from salary is 4,90,000. Now, what is tax on above? Tax on above, he is under the old regime. So up to 2,50,000, 2,50,000 to 5,00,000. 2,50,000 to 5,00,000. There is only 2,40,000 lying there. 2,40,000 is the total amount which is lying there. 2,40,000 into 5%. 2,40,000 into 5% will come to 12,000. And since his income is less than 5,00,000, you can claim a rebate. Rebate under section 87A. For persons whose income is less than 5,00,000, there is a rebate, 12,000. Maximum rebate is 12,500. So 12,000 rebate, tax paid is nil. Liability is nil. Okay. So this is the rule if you are accepting HRA. And now what we have to calculate simultaneously is what is his cash flow, net cash inflow. How much is his net cash inflow? The decision has to be taken on the basis of cash inflows and outflows. That is what the question says. It is not to be taken on the basis of tax liability, but how much of cash will be in your hands in either of the cases. So net cash inflow. Let me first write down What are the cash inflows? Cash inflows. What are the various types of cash which he received? First one is basic salary. Basic salary he receives 4,80,000, and he also receives HRA. HRA he receives 84,000. Only these items are received by him. Okay, only these two items are received by him. And what are the cash outflows? Cash outflows. Cash outflow, there is only one item, rent. Rent. Rent paid is 72,000. See, in this question, there is no tax liability, but if there had been any tax payable by him on the basis of the slab, you should write down that as well. Here, there is no tax payable, so there is only one cash outflow. So net cash inflow will be, net cash in hand will be, net cash in hand will be 5,64,000 minus 72,000. 4,92,000 will be the cash in hand if he goes for HRA. Okay, 4,92,000 will be the cash in hand if he goes for HRA. I repeat, if there is any tax payable on this calculation, this has also to be shown as outflow. Now let us take the second case. Second case is he is accepting rent-free accommodation. He is accepting rent-free accommodation. If he goes for rent-free accommodation, what is his basic salary? Basic salary is 4,80,000. Rent-free house, we have to make separate calculations up to August. Since there is only one step, let me do it here itself. Up to August, it is 4,80,000 into 5 by 12 into 15%. 5 months salary into 15 by 100. From September onwards, for 7 months, it is 4,80,000 into 7 divided by 12 into 10 divided by 10%. $28,000. So the value of house is 8. Total it will be gross salary. Same method. There is no further calculation required. Gross salary. Standard deduction. Income from salary. $4,80,000. Here also, since the amount is less than 5 lakh, there is no tax liability. But even then, we have to make the calculation. We have to write down all these. Even though tax payable is nil, we have to write down all these. On 4,80,000, the tax will be 4,80,000 minus 2,50,000. 4,80,000 minus 2,50,000 into 5%. 11,900. The entire amount can be claimed as rebate and there is no tax payable. Okay. Here also there is no tax payable. Now let us find out how much is cash outflow. See, in your study material, they have calculated the value of house at 4,80,000 for the entire year, 15% for the entire year. They have calculated value for the whole accommodation at the old rate. Full year they have calculated at the old rate. So 4,80,000 to 15, they have not made this bifurcation. Okay, they have not made the segregation. But ideally, this is the way you have to calculate. This might be an old edition, that might be the change. So 4 lakh 80 plus 72, you get 5 lakh 52. From that, 50,000 standard deduction, 5 lakh 2,000. Here there will be no rebate as the income process. 5 lakh, there will be no rebate. There is tax payable. Okay, tax payable. So now let us calculate what is the net cash inflow. What is the net cash inflow? In this case, what is the net cash inflow? Basic salary is 4 lakh 80. There is no other cash receipt, no other cash paid. So net cash inflow will be 4 lakh 80. Here it is 4 lakh 92. So on this basis, what shall be our decision? We have to choose HRA, then only we have more cash in hand. We have to choose HRA, then only we will have more cash with us. Okay. How we calculate this is how we calculate net cash inflow and identify which is better. Okay. So with this, I think we'll be completing salary, the chapter from salary. We can move on to the next chapter, income from house property. We'll move on to the next chapter, this income from house property. Income from house property. As we all know, this is comparatively easy when we compare that with in other heads of income. Income from house property and income from other sources are comparatively the easier chapters. So section 22 to section 27 of Income Tax Act deals with house property income. We'll first start with section 22, that is basis of charge. Okay, section 22 is the basis of charge. When do you call an income as house property income? In order to treat an income as house property income, there are 3 conditions to be satisfied. There are 3 conditions to be satisfied in order to treat an income as house property income. One is, property should consist of building or land appurtenant thereto. Appurtenant means connected thereto. So first and foremost condition in order to charge an income under the head house property is that there should be a building. If there is no building, then there is no house property. And income from land can also be treated as house property income. Income from land will also be treated as house property income, provided that land is connected to the building. See, I'll give you an example. Like I own a flat. I have rented it out. I have a flat. I have a car parking space associated with the flat in the, there is an underground car parking space where each flat will be allotted a specific space. So I have purchased it by paying certain amount. I have purchased my car parking space. So that car parking space is also rented out to the tenant. And I'm asking my tenant to give me 10,000 for the flat and 2,000 for the car parking space. Altogether, he's paying me 12,000 rupees. 10,000 for the building and land, 2,000 rupees. So together I get 12,000. Here 12,000 is received for building and land, but this land is connected to the building. The letting out of land is connected to the letting out of building, and hence that land is also, the income collected towards land is also treated as house property. On the other hand, there is no building. There is just a vacant plot of land, which I have rented out for an exhibition ground. for somebody. I own an exhibition ground. Okay, I have a huge plot of land and I rent it out to some persons and they will construct all the tent there. There is no building there. The tenant will be constructing some sort of tent and shed and they are doing some exhibitions there. Rent which I receive for such vacant plot of land, it cannot be called as house property. Instead, that will be charged under other sources. Rent from vacant plot. There is no building, there is no house property, then you go to other sources. All right. Second point is, you are to be the owner of the property. You are to be the owner. If an income is to be called as house property, the SSC, that is the person, only the person who owns the building has to pay tax to the government under the net house property. Let's give another example. I own a property. I let it out to Mr. A. Mr. A lets it out to some other person. Okay. I own a property. I let it out to Mr. A. Mr. A again lets it out to another person. I receive rent. Mr. A also receives rent. The rent which I receive is charged on the house property because I am the owner. But the rent which Mr. A receives, he is not the owner of the property. He is a tenant of the property. He is doing subletting. And subletting is not taxable on the house property because the person who sublets, he is not owner. So the rent received by Mr. A, it is not charged on the house property, it will be charged under again other sources. Okay. Third point. This building shall not be used by SSC for his own business or profession. Building shall not be used by SSC for his own business or profession. See, if you are using your own building for your own purpose, there is no income. Practically, there is no money which you are receiving. Your building, you are using for your own purpose. What is the monetary benefit there? There is no monetary benefit there. So that property is not considered under this head. If you are using the building for your own business or profession, it's not charged under the head house property. No income received. Okay. So these are the three conditions that have to be satisfied in order to charge this income as house property. The first condition is it should be from building or land connected to building. You are the owner. It is not used by SSC for his own business or profession. Okay. Deemed owner. Deemed owner means a person who is not actually owner of the property will also be liable to pay tax, even though he is not a registered owner. Even though he is not a registered owner, this person will be liable to pay tax. A person other than the registered owner is liable to pay tax, and that person is called as deemed owner. A person other than the registered owner will be liable to pay tax. That person is called as deemed owner. So let's see section 27. Who is the deemed owner of the property? Who is the deemed owner of the property? There are 5 categories. Okay. There are 5 categories where a person will be called as a deemed owner. Category 1 is Mr. A, an individual, he transfers a house property. This property is transferred by Mr. A to his spouse or minor child. All right. So Mr. A transfers a property to spouse. Let us take his spouse. Mr. A transfers a property to Mrs. A. And Mrs. A is not, the property is transferred without adequate consideration. The property is transferred without adequate consideration. Absolutely free. Or the property is transferred not under an agreement to live apart, without an agreement to live apart. There is no divorce, no consideration. Do you understand the second point? No divorce, no consideration. Mr. A transfers a property to Mrs. A. No divorce, no consideration. Even though the property is now in the hands of Mrs. A, who is liable to pay tax, Mr. A is liable to pay tax. Even though now the property belongs to Mrs. A, Mr. A is liable to pay tax. So individual transfers a property to wife, or the other way. Wife transfers a property to her husband. No divorce, no consideration. Okay. Then, even though now property is in the name of the spouse, tax will be payable by the transferor, the individual. Same is the case where you transfer a property to minor child. A property is transferred to minor child without consideration. Even though now the property is in the name of minor child, the parent will be liable to pay tax. Parent is a deemed owner. But this provision is not applicable when the property is transferred to a minor married daughter. This provision is not applicable. That is, deemed ownership provisions are not applicable if the transfer is made to a minor married daughter. So if the property is transferred to a minor married daughter without adequate consideration, the daughter is the owner of the property. These provisions are not applicable. Minor married son, these provisions are applicable. Minor married son, this provision will be applicable. Minor married daughter, this provision is not applicable. Okay, so that is category 1. Category 2. Category 2, deemed ownership, second case, category 2. Holder of impartible estate is the deemed owner. Holder of impartible estate. What do you mean by an impartible estate? Impartible estate means the property cannot be partitioned. Property cannot be partitioned. A person only has the right of possession of that property. There may be some family rules like senior most member of the family can enjoy a property. If that senior most member dies, the second senior most member of the family enjoys the property. But these members, they don't have a right to sell the property. Okay. Then the person who holds the property for the time being is treated as a deemed owner of the property. Okay. Category 3. There is a cooperative society or a company or an AOP which is formed for the purpose of house building. There is a cooperative society or a company or an AOP that is formed, and the objective of forming this company is for the purpose of house building. And what happens is, any person who is a member of a cooperative society will be allotted a house. If you are a member, you will be allotted a house. Okay. When you look into the title deeds, the property will be lying in the name of cooperative society. It will not be lying in the name of member. The registered owner as per the document will be the cooperative society, but deemed owner is the member. Okay. The registered owner of the property as per documents will be cooperative society, but the deemed owner is not cooperative society, is not the owner. Member who is given a property, who is allotted, that is a word which we use, who is allotted a property will be the deemed owner. Now, if at all when a member wants to transfer his property, he makes a document as if he has transferred the membership. Transfer of membership is equivalent to transfer of property. Transfer of membership is equivalent to transfer of property. Okay, so the member is the deemed owner. Category 4, a person who is a deemed owner. Category 4. Generally, we know we are talking about here land and building. So for land and building, the registration of the property is compulsorily required. If how do I prove that I am owner of a property? How do I prove that I am owner of a property? I prove it by showing the registered documents in my name. So registration of document is compulsory for a person to become owner of the property. But Section 53A is an exception to this rule. Section 53A of Transfer of Property Act says that this is an exception to this rule. A person will be deemed owner even if the registration has not happened. Let's take an example. Let me first explain the example and then you may read the point. First case is that I purchased a property from Mr. A. Okay, I purchased a property from Mr. A. The property was purchased in, let us take month of April. Month of April, I purchased property means I entered into an agreement to purchase the property and I also paid entire consideration to Mr. A. But what happened is, Mr. A is an NRI. Mr. A is an NRI. So Mr. A says that he'll be coming to India only in the next December. Okay, he'll be coming only during the Christmas season. He'll be coming to India. So what Mr. A suggested is, Mr. A asked, he said, you pay me the money. Now I'll do one thing. I will give you the possession. I'll give you the key. You can collect the key from my family member staying in India. So I transferred entire money to Mr. A's account and I also took possession of the property. But the registration happens only in next December. Okay, I took possession in April. From April to September, I am enjoying the possession, but I'm not the owner of the property from April to September as per the document. As per the document, Mr. A continues to be the owner of the property up to December. Now, I took possession, I let it out from May onwards. The property is let out from May onwards. Okay, next month, the property is let out. From May to December, I am receiving rent, but the property as per the document, Mr. A is the owner of the property. Okay, but I'll be called as deemed owner. So you need not wait till the registration is over. That is what section 53A says. You need not wait till the registration is over. The moment you have paid money and you have taken possession, you are the deemed owner. Okay, so from April to December, you'll be called as the deemed owner of the property. The rent received will be taxable in my hands. It will not be taxable in Mr. A's hands, even though he is the registered owner. So that is category 4. Category 5. Category 5 says that a person who acquires possession of a property through a lease for a period of more than 12 years is the deemed owner of the property. Okay, person who occupies possession of a property under a lease will be for a person who occupies a property as a tenant for more than 12 years is the deemed owner. Occupying a property as a tenant for a period of more than 12 years, you are the deemed owner of the property. So these are the 5 cases where a person will be called as deemed owner of the property. Which are the 5 cases? First case is husband transferring a property to wife without consideration, no divorce. Then, even though now the property is in the name of wife, husband is the deemed owner. Same is the rule when we transfer property to minor child. Minor child, but if she is a married daughter, this section is not applicable. Then the married daughter is the owner of the property. Category 2, holder of impartable estate is the deemed owner of the property. Category 3, you are a member of a cooperative society. Cooperative society is formed for house building. The registered owner of the building is cooperative society, but the deemed owner is the member. Category 4, registration happens only later, no problem. The moment you have taken possession of the property after paying the consideration, you are the deemed owner. Category 5, a person who is occupying a property as a tenant for a period of 12 years is the deemed owner of the property. Now we come to section 22. Section 22 says that 3 conditions are satisfied, you are the deemed owner, right? 3 conditions are satisfied, you are the deemed owner. What it says now is, it may not be always possible to strictly adhere to the taxation just by following section 22. In many cases, we have to find out we have to read some other sections together for the purpose of taxation. Just by going by section 22 alone will not help. Something extra have to be added or something have to be just ignored. What is that? First case. Let us take you are a non-resident. You are a non-resident, right? You own a property in a foreign country. Property is situated in a foreign country. Rent is received in a foreign country. Non-resident has a foreign property. Rent is received in a foreign country. As per section 22, if 3 conditions are satisfied, you are taxable under house property. You have a building. You are the owner. It is not used for business or profession. So in respect of that foreign property which you own, these 3 conditions are satisfied. It's a building, you own it, and you don't use it for your own business or profession. It is let out. It is let out to some other person. But you are a non-resident, right? You are a non-resident, and this is a foreign income, right? Okay. Foreign income is not taxable for non-resident. Is it not? So even though section 22 conditions are satisfied, you have to read something else. The scope of income, section 5. What does section 5 say? Only Indian income is taxable for non-resident and not ordinarily resident. House property income, not ordinarily resident, is not taxable in respect of that foreign income. So only the rent of that foreign property is received in India. Only the rent of that foreign property is received in India. This income will be taxable. Is that understood? Only if rental income of a house property situated in India, foreign house property, rental income shall be received in India. Only then that house property income will be taxable for not ordinarily resident and non-resident. Ordinarily resident, Indian income or foreign income is absolutely taxable. So that is the first point. We have to read some other section together. Not by going section 22 alone will help you. Okay. Going by section 22 alone will not help you. Read the general clauses as well. The sections which are before that and also the sections after that. Read that in totality, not by section by section. Right? So that is point number 1. Second point, the ownership is in dispute. There is a property, father died. We do not know. There is a case which is there is a dispute which is being contested, a case which is being carried out in a court of law by the elder son and the younger son. The elder son says property belongs to me. Younger son also says property belongs to me, and they are contesting it in a court of law. There is a case which is being done, and the ownership is in dispute. The final verdict has not come out. The final verdict has not come out. For the past so many years, this has been in court. For the past so many years, this case is in court. Who will pay tax? First, we said only for your honor you need to pay tax, but here we will ignore that condition. A person who actually receives benefit, even if he is not honored, will be liable to pay tax. So the elder son is collecting all the rent. He cannot escape tax liability saying that I am not owner of the property, that we are contesting the case and all that. He will have to pay tax even if he is not owner of the property. Even if he is not owner of the property, if he is enjoying benefit, he has to pay tax. Okay. Next case. Next case. Is held as stock in trade. There is a house property which is held as stock in trade. Who holds a house property as stock in trade? A builder of the property, a real estate developer. So there is some builders. Let us take prestige builders. Okay, prestige builders, they are constructing so many flats. They have constructed around 50 flats in this area. If they have constructed a flat here, there are around 50 apartments in that complex. 50 apartments. They could sell only 30 flats. They could sell only 30 flats. They have been waiting for the sale of the property, but no response for the last 2 years. So what they thought is, they thought we will let it out for the time being. We let it out for the time being. Till somebody comes and approaches us for purchase of the property, we'll do one thing, we'll let it out. So they have let out their stock in trade. A real estate developer has let out property, but that property is a stock in trade. He has not constructed it for his own use or for his investment purpose. He is doing business. So when rent is received from stock in trade, people generally get confused. Under which head would we tax it? Whether we should tax it under house property or whether we should tax it under business. Since it is stock is connected to business. So whether we should charge it as business income or house property income. It has been held that even if it is held as stock in trade, rent received will be taxable under the head house property. That is whether you receive rent from your fixed asset or current asset. See, when you think of your balance sheet, fixed asset and current asset, stock comes in under current asset. Whether you receive rent from fixed asset or current asset, that is taxable as house property income. However, there are two exceptions. In two cases, rental income is taxable as business income. Rental income is taxable as business income in two cases. Actually, that was decided in a case law, Rayala Corporation Private Limited versus Assistant Commissioner Income Tax. That was a Supreme Court decision of 2016. And in two cases, when we receive rent, we will tax it under business income and not under house property. When is that? One, your business is letting out. The main objective of your business is letting out. Okay, your objective is letting out. Whose main objective is letting out? Who is the person whose objective can be letting out? See, lodges, hotels. Their business itself is letting out of property. Okay. When we are talking about a real estate developer letting it out, his business was not letting out. His business was sale of property. Here, I have constructed a hotel and I have constructed this hotel just for the purpose of letting out. It's not meant for resale. I don't have any plans to sell this building, sell this hotel. My objective is to get income, rental income from this hotel. So my objective is to let out the property. Then the rental income will be charged as business income. Second point, your main business is not letting out, but your incidental business is letting out. Incidental business is letting out. First case, your main business is letting out, the hotels. Second, your incidental business is letting out. How can that be explained? Again, let me give you an example. I'm conducting a coaching institution. Let us assume that I run a coaching institution, an entrance coaching institution. My main objective is not letting out. My objective is to impart education to the students. But what I do is I also run a hostel. Some of the students in my class stay in the hostel which I run. Here, the hostel helps my coaching business, is it not? Because many times parents, when they know that I have a coaching center, I have a hostel attached to a coaching center, they'll be tempted to admit their ward in my education institution. So I I run a coaching institution and I also run a hostel. The hostel business helps my coaching business. But my main business is not running hostel. In that case also, the income which I receive from my hostel, from my students, will be taxed as business income. So these are the two cases where house property, that is rental income received, is not taxed under house property. It is taxed under business. One is main business letting out, hotels. Second, which is run by a coaching institute. Now there is something called as composite rent. Composite rent. Composite means you receive rent just not for building, but for some other services as well. Some other services. How do I explain that? I own a flat that is let out. I own a flat and that is let out. But along with that, there are so many facilities or amenities which are offered in my flat. So many facilities or amenities which are offered in my flat, like there is a gym, there is a health club, there is a swimming pool. You are staying in this flat means you can enjoy all those benefits as well. But give me extra rent. Give me extra 2,000 for that. If you want to enjoy all these facilities here, the gym, you have a lift operator here. I have to pay him salary. We have a park there. Evenings you can stroll around. There is a garden there. But pay me extra 2,000 because I incur expenditure on maintenance of all these. I have to pay salary and wages to the lift operator. I have to maintain the garden there. So give me extra money for all those. You are enjoying you are staying and you are enjoying, and I am incurring expenditure. So you should give me some extra money for that. So 10,000 again you give me for the building and 2,000 for the services. 10,000 no doubt we can charge in the house property, but the amount which is collected for services, that is not to be charged in the house property. That will charge either as business income or IFOS, depending upon the facts. Either as business income or IFOS. See, whether it is frequently carried out, that will be charged under PGBB. One straight transaction during the year, that will be charged under other sources. Okay. So that is regarding composite rent. Then, second case is inseparable letting. Inseparable. What do you mean by inseparable letting? Inseparable letting means letting of building done along with furniture. Letting of building done along with furniture. And you have to take both. There is no option. If you want to take this building on rent, take the furniture as well. You need it or not, that is not my concern. I'm letting out a factory building. If you want a factory building, take that machinery as well. I may be having a machinery related to textile. You are doing a business here relating to atom bomb. I'm not concerned. Take that machinery as well. You have to give me rent for that machinery as well. So that letting is called as inseparable. That is, we cannot differentiate, we cannot divide letting of building and letting out of machinery. In that case, no income is charged under house property. Entire income is charged under IFOS, income from other sources. If letting is inseparable, the entire income will go to IFOS. Okay. On the other hand, if letting is separable, If you want only building, fine, take building. If you want only furniture, fine, take furniture. Will the letting is separable, then amount relating to building will be charged under house property. Relating to machinery or furniture will go to PGBP or IFOS. Okay, so that is regarding composite rent. We have a problem about composite rent. We'll do one. Okay, we have a problem from composite rent. We are coming to the actual computation aspect. How do we compute income from house property? What is the format for computation of income from house property? Income from house property, the format is like, we'll first start with something called as gross annual value. And this is the main thing which we have to identify here. Gross annual value. See, I have not used the word rent receipt. I have not used the word rent receipt. It's gross annual value. From gross annual value, whenever we hear about gross annual value, we know we have to claim something further as deduction, and that is what is municipal taxes. I receive rent for this property. I get rent for this property, but I have to pay building taxes to the government. I have to pay building taxes to the government. So municipal taxes is deducted. Balance is called as net annual value. Gross annual value less municipal taxes, net annual value. Net annual value, there are two deductions. Deductions are given under section 24. One is a standard uniform deduction for all, as in the case of salary. And there is a interest on borrowed capital. That is interest on loan taken. I have constructed this building using a loan from bank. So I'm paying this an additional expenditure which I'm incurring that I can claim as deduction. Okay, it's pretty simple a format. Gross annual value, municipal taxes, net annual value. After deducting municipal taxes, the amount which you get is called as net annual value. From net annual value, there are two deductions. Standard deduction and interest on borrowed capital. Balance is called as income from house property. So first of all, let us see how do we compute gross annual value. How do we compute gross annual value? Gross annual value is computed by comparing two terms. One is called as reasonable expected rent. Let me call that RER. RER, the expected rent in this area. Okay. And then we have to compare that with actual rent, the rent which you have actually received. Always compare the rent received with the expected rent of this area, so that you are to ensure myself that rent is not underquoted. You may understate your rent. You may be saying that you have received only a rent of 2,000 per month, whereas the market rent in this area might be around 20,000. But you're saying that you have received only 2,000 per month. So I'll always compare the rent which you have received with the expected rent here. Okay, so these are the two terms which we have to compare. But how do we arrive at RER? How do we arrive at actual rent? How do we arrive at RER and how do we arrive at actual rent? RER is obtained by comparing three terms. RER is obtained by comparing three terms, that is municipal valuation, fair rent, and standard rent. Municipal valuation is a value which is determined by the municipality. So whenever you have to construct a building, you have to get approval from the planning board, is it not? The town planning board. There is a specific authority in the municipality that gives approval to all your building plans. So when they are giving approval to building plans, they'll be assigning a value to this property. The value which is assigned by depends upon the square feet of the building, the area where it is located. Based on all these, they might assign a value, and that value is called as municipal value. Okay. Fair rent is the market rent. Fair rent means there is a market rent. Rent of the similar property in the area. That is what is called as fair rent. So compare municipal valuation and fair rent. Choose whichever is higher. Okay. Compare municipal value with fair rent. Choose whichever is higher. So we got one amount in step one. Compare that step one amount with standard rent. Standard rent means that is a rent which is fixed by Rent Control Act. Standard rent is a rent which is fixed under Rent Control Act. See, for some reason, you don't receive the rent from your tenant. What would you do? What would you do? If somebody does not pay you rent, that is an unsecured debt, is it not? Unsecured debt. How do we ensure that that rent is received? You will file a case. You will file a suit. There is no other way. There is no other way to recover that rent. So when you file a suit against a defaulting tenant, the court will order that this much rent will be collected and given to you. And all those are fixed under Rent Control Act. So the amount which the court will award you in case of a defaulting tenant is called as standard rent. So never you can get something above standard rent. Let me explain once again. Municipal valuation of a property is 1,20,000. Fair rent of the property is 1,50,000. You have to choose higher of these. Higher. Higher means we choose 1,50,000. Now standard rent is 1,40,000. Standard rent is 1,40,000. What does this 1,40,000 signify? In any case, if you file a suit against the tenant, award a maximum of only 1,40,000. In the worst case, if you go for a case, in the worst situation, if you go for a suit against a tenant, you will get only 1,40,000. You cannot get more than 1,40,000. The court will not award you more than 1,40,000. So what would be your expected rent? Expected rent is not 1,50,000 there. Expected rent is only 1,40,000, which means this higher amount and standard rent are to be compared. Higher amount and standard rent are to be compared. And here we have to choose whichever is lower. Okay, so let me repeat the step. How to arrive at RER. How to arrive at RER. Compare municipal valuation with fair rent. Choose whichever is higher. That higher amount with standard rent. There we choose whichever is lower. Okay, so here we have identified that our expected rent is 1,40,000. So we have got one calculation. We have got 1,40,000 as the expected rent.
Account.
1,40,000 is the expected rent. Now we'll come to actual rent. Okay, what is actual rent? Actual rent means the rent which you have actually received. That is rent for the year, annual rent, minus unrealized rent, annual rent minus unrealized rent, minus loss due to vacancy. That is what is called as actual rent. Annual rent minus unrealized rent minus loss due to vacancy. Let us see what is the difference between unrealized rent and loss due to vacancy. Unrealized rent means the tenant was staying in the property, but he did not pay me any rent. I could not recover any rent from him. He was there in the property. Loss due to vacancy means I did not receive any rent because the property was shut down. It was vacant. That is the reason why I did not get any rent. So let us again take an example how to arrive at actual rent. Okay. Rent for the year is, let us take the annual, the monthly rent for the year is 30,000. It is 30,000 per month. Okay. Unrealized rent is for 2 months. And vacancy is for 1 month. Vacancy is for 1 month. So actual rent is received only for 9 months, right? 30,000 to 12 minus 2 months deducted, 1 month deducted. So actual rent is 30,000 into 9, which is equal to 2,70,000. This is the actual rent which you have received. This is the actual rent which you have received. So we have two figures with us. One is expected rent, 1,40,000, and the other one is actual rent, 2,70,000. When you get these two items, how do we arrive at GAV now? So we have to get GAV by comparing RER and actual rent. RER is 1,40,000, actual rent is 2,70,000. How to arrive at GAV? Actual rent is higher than RER. Okay, actual rent is higher than RER. See, the Income Tax Act expected a rent of only 1,40,000. But you are saying that you received a rent of 2,70,000. Very good. If you have received 2,70,000 as actual rent, pay taxes on actual rent. Department will be more than happy to receive that taxes. So if actual rent is more than expected rent, then GAV will be 2,70,000. That is it. So we have to see what happens if actual rent is lower than RER. Actual rent is lower than RER. If actual rent is lower than RER, I'll ask you two questions. Why? What happened? Why is actual rent lower? You have to answer that. You have to give me an explanation. You owe an explanation. If actual rent is lower, if actual rent is higher, I do not want to know the reason. I do not want to know the reason. But if actual rent is lower, I will ask you why. Why is actual rent lower? Then you are saying that, sir, actual rent was lower on account of vacancy. I will tell you, fine, no problem. You need to pay tax only on your actual rent then. If vacancy is the problem, okay, I understand. I understand. I am with you. You need to pay only for actual. You need to pay taxes only for actual rent. On the other hand, if you are telling me some other reasons, I will tell you, no, I don't want to hear anything else. I don't want to hear anything else. You pay tax on your RER. Always what the department will consider, the act requires is that, the Income Tax Act says that minimum you have to pay taxes for RER. Minimum. That is, you should let out your property at minimum RER. If that is not received on account of vacancy, okay, agreed. You need to pay tax only on actual rent. Otherwise, why are you letting your property at a value lower than market rent? Why should you let out your property at a value lower than market rent? If the market rent here is 20,000, why should you let out your property at 2,000? Why are you doing that? I don't want to hear all these things. Pay taxes for 20,000 then. Is it not? You're letting out only for 2,000. That is your problem. Why are you doing that? Pay taxes for 20,000. So any other reason, I do not want to hear. Okay. I will ask for the reason if the actual rent is lower, and we'll see how that we will understand all those things. I'll give you an example. Let me tell you one more point. If property is vacant throughout the year, entire 12 months the property was vacant, that is, entire 12 months the property was vacant. It was not let out on a single day. Okay, then what happens? Actual rent is lower. Actual rent is zero. The property is not let out for a single day. Actual rent is zero. Actual rent is zero because of vacancy. If it is because of vacancy, then actual rent need to be taken. What is actual rent? Actual rent is zero. GAV is zero. Right? So that is regarding the calculations. Let me give you one example as to how we find out whether actual rent was lower on account of vacancy or due to some other reason. Okay, let me change this example. Let's take this case. Rent is 5,000 per month. Then your actual rent is only 5,000 into 9, is it not? Like 2 months vacant, 1 month vacancy, so 3 months rent gone that way. Your actual rent is only 45,000. So here your actual rent is lower than the expected rent of 1,40,000. Now, if you tell me that actual rent is lower, I will ask you the reason. So you are saying that the property is vacant. Okay, then I will tell one reason. If there is no vacancy, if the property is not vacant during the year, what will be your actual rent? If there is no vacancy, you are saying that the property was vacant for 1 month. Fine. If there is no vacancy, what will be your actual rent? Your actual rent would be 50,000. Vacancy is zero. If vacancy is zero, your actual rent will be only 50,000. So even if there is no vacancy, you have received only 50,000. Even if you have no vacancy, you have received only 50,000. So what you have to do is, you have to add back vacancy to the actual rent. You are adding back vacancy to the actual rent. Okay. So now I understand that even if there is no vacancy, you have let out your property only for 50,000. So vacancy is not the villain there. Vacancy is not the villain. Okay. Unrealized rent is the villain. Or another villain might be that you have underquoted your rent too much low. You have underquoted the rent. What is your expected per month rent? What is your expected per month rent? 1,40,000 divided by 12. The expected rent in this area is 11,667. This is the expected rent in this area. And you are letting out your property at a meager amount of 5,000. Why? Why should you do that? I don't want to hear all those excuses. So here, the rent is actual and is lower, not on account of vacancy. And how do we identify that? We will add back vacancy to the actual rent of 45. And we will identify how much is the actual rent if there is no vacancy. If there is no vacancy, your actual rent is 50,000 and expected rent is 1,40,000. So even if there is no vacancy, your actual rent is only 50. So it's not on account of vacancy, it's due to some other reason. So in this case, GAV will be 1,40,000. So when you're doing problem, what you have to do is there are 4 steps in which we do this problem. Okay, there are 4 steps. First, we will identify RER. RER is 1,40,000. Then we will identify actual rent as 45,000. Then we'll do one more step. Actual rent if there is no vacancy. Actual rent if there is no vacancy. But this step is to be used only if the actual rent is lower. Only if the actual rent is lower. Okay, if there is no vacancy, your actual rent is 50,000 because there was a vacancy of 1 month. 1 month rent is 5,000. If that is not there, your actual rent, then again your actual rent would be only 50,000. And if this step 3, okay, if this step 3 is lower than RER, if this step 3 is lower than RER, then GAV will be RER. If step 3 is more than RER, then actual rent would be GAV. Actual rent would be GAV. Okay. If step 3 is lower than RER, then what does that mean? Vacancy is not the culprit. Vacancy is not the culprit there. Even if there is no vacancy, your rent here is only 50,000. You have let out your property only for 50,000, whereas the expected rent is 1,40,000. So it's not vacancy, some other reason. If there is some other reason, GAV will be RER. On the other hand, let me again change this question. Rent per month is 12,000. Okay. So let us make it 14,000. I think we have to make it 14,000. Let me see. Actual rent is 14,000 into 9. 1,26,000. Can we make it 15 then? Or I'll change my standard rent. That is better. I'll change my standard rent. Let us come to this case. Let's come to this case. Standard rent is 1,30,000. We have taken whichever is lower. So expected rent here is 1,30,000. I have let out my property at 14,000 per month. There is 2 month unrealized rent and 1 month vacancy. So actual rent is 14,000 into 9. That is equal to 1,26,000. If there is no vacancy, then my rent would be 1,26,000 plus 14,000. We add back, and then it would have been 1,40,000. See, I have let out the property at 1,40,000. But I did not receive 1,40,000 because there was vacancy. That is the reason why actual rent is only 1,26,000, which means step 3 is more than RER. Let me continue this example. 1,26,000, 1,40,000. Step 3 is more than RER. That is, if there is no vacancy, I would have got 1,40,000. Because of vacancy, I got only 1,26,000. Okay, this is more than RER. So here your GAV will be actual rent. Here your GAV will be actual rent. Here your GAV will be RER. This is how we calculate. We calculate GAV in 4 steps. RER, actual rent if there is no vacancy, and GAV. But this step is to be used only if actual rent is lower. Only if actual rent is lower, you have to apply this step. If actual rent is higher, you need not apply this step. If actual rent is higher, there is no need to apply this step. Actual rent will be directly taken as GAV. Okay, so this is how we calculate GAV. Now, once we calculate GAV, that is over, we'll go to the format. What are the other items which we have to do here? We have to deduct municipal taxes. What are the conditions to be satisfied to claim deduction for municipal taxes? Municipal taxes will be allowed as deduction. Only two conditions are satisfied. One, that municipal taxes shall be paid by the owner. We are calculating owner's profit. So only owner's expenditure will be allowed as deduction, because sometimes we might see that tenant has agreed to pay the municipal taxes. Tenant might have agreed to pay the municipal taxes. If tenant has agreed to pay the municipal taxes, then there is no deduction for the owner for that much amount which the tenant has paid. So it shall be borne by the owner and it shall be paid during this year. It is allowed as deduction on cash basis. Amount which is paid by you actually from 1/4/23 to 31st March 24 will be allowed as deduction for previous year 23-24. See, the municipal taxes has become due on 28th March 24. Okay, municipal taxes have become due on 28th March 24 and you pay it only on 5th April 24. You pay it only on 5th April 24. There is no deduction for previous year 23-24. There is no deduction. You pay it, then I will give you deduction. So deduction will be allowed only in 2024-25 financial year. Then third point, municipal taxes paid outside India is allowed as deduction. Municipal taxes paid outside India is allowed as deduction. You are a resident and ordinarily resident. Agreed? You are resident and ordinarily resident. You have to pay taxes for your foreign property. Is it not? You have to pay taxes for your foreign property, since you are a resident and ordinarily resident. When income in respect of a foreign property is taxable, expenditure in relation to a foreign property can also be claimed as deduction. So even though municipal taxes is paid outside India, that will not make any difference. That can also be allowed as deduction, and that was allowed in the case law CIT versus Venugopala Reddy. Okay, so municipal tax is over. We arrive at net annual value. From net annual value, there are two more deductions under section 24, 24A and 24B. 24A is the standard deduction. There is a uniform deduction for all. And the amount of standard deduction in house property is 30% of net annual value. 30%. If net annual value is 1 lakh, deduction is 30,000. If net annual value is 2 lakh, standard deduction is 60,000 and so on. That is a uniform fixed standard deduction for all. And the objective to provide standard deduction is to allow your expenditure in relation to this letting out. See, I earn income from this property, I understand. But in relation to this property, I have to incur expenditure by way of repairs. I have to repair this property. I have to incur, I'm incurring expenditure by way of insurance, depreciation. The tenant has been using this property. See, he has made this very dirty, this property. So the value of the property is deteriorated. Passage of time, we know all that. The property value gets deteriorated over a period of time, depreciated over a period of time. In order to cover all those actual expenditure, I give you a standard deduction. I don't consider the actual expenditure. Your actual expenditure might be more than 30%, or your actual expenditure might be lower than 30%. No, I'm not looking into your actual expenditure. Instead, I'll give you a 30% standard deduction, uniform standard deduction, 30% of net annual value. Okay. So when the question contains some repairs, insurance, depreciation, just ignore that. Okay, ignore all those things. Ignore all the actual expenditure. Instead, give standard deduction 30%. After that, the last and final amount which we have to consider is interest on loan. Interest on loan can be of two types. One is current year interest and the other is pre-construction interest. There is current year interest and there is also pre-construction interest. We'll first discuss what is current year interest, okay, or what are the conditions to claim deduction for current year interest. Current year interest deduction can be claimed only 4 conditions are satisfied. 4. Keep in mind 4 conditions. 1, the loan which I have taken is for purchase of this property. Purchase also include construction and or it may be taken for repairs of the property. Repairs can be renewal, etc. So the loan is taken for purchase or repairs. Okay, loan is taken for purchase or repairs. Second, deduction is allowed on accrual basis. Deduction is allowed on accrual basis. Accrual meaning the amount which has become due for the year is allowed as deduction. actual amount of interest which has become due for the year. Like, let me give you an example. I have taken a loan of 50 lakhs for construction of this property. 50 lakhs. Rate of interest is 10%. No interest has been repaid so far. So the interest which is due for the year is 50 lakh into 10%, which is equal to 5 lakh. I repaid 4 lakh 50 interest during this year. I can claim a deduction of 5 lakh. I paid 5 lakh 50,000 during this year interest, but again my deduction is 5 lakh. Deduction is allowed on accrual basis. It's a sharp contrast with municipal taxes. Municipal taxes was allowed as deduction on cash basis. This is allowed as deduction on accrual basis. All right. Then, third point, we are all talking about current year interest now. Third point, interest on unpaid interest is not deductible. Interest on unpaid interest is not deductible. Penal interest, we'll call that as penal interest. Let us take an example. The total interest which is payable by me on 5th of every month. Every month 5th I have to pay interest. Okay. So every month 5th I have to pay around 15,000 as interest. That is the interest which is charged by the bank. 15,000. But I couldn't pay the interest on 15,000. So what happened is I paid it on 25th. And when I went to bank on 25th, they charged me a penal interest. They collected from me 15,000 interest plus 2,000 penal interest. So altogether, I paid 17,000. I can claim deduction only for 15,000. Interest on unpaid interest is not allowed as deduction. Interest on unpaid interest is not allowed as deduction. Okay. Fourth point. Fourth point which can be claimed as deduction is, again, let me give you an example, then we will read the point and then identify. I had taken a loan from Punjab National Bank. Initially, I had my housing loan and that housing loan was from Punjab National Bank. Okay. Housing loan was for 50 lakh. Let us assume that it's the 10% interest. So up to December, the interest which is due upon this is 50 lakh into 10% into 9 by 12. Let's calculate that. Let's calculate that. 50 lakh into 10%, 5 lakh into 9 by 12. This is the total amount of interest which is due up to December. This housing loan was from Punjab National Bank. Okay, Punjab National Bank. Now what happened is, January, State Bank of India approached me and they said that they will advance a loan of 50 lakh itself, but that 50 lakh will be advanced at 8%. They will advance me a loan of 50 lakhs, but that 50 lakh they will advance at 8%. So definitely I would agree that because Punjab National Bank, I'm paying an extra rate of 2%. So I agreed. I took a loan of 50 lakhs from State Bank of India. And what did I use this loan for? This 50 lakh loan from State Bank of India was used to repay Punjab National Bank loan. Is it not? 50 lakh loan taken from State Bank of India was used to repay Punjab National Bank loan. Do you follow? So anyway, let us calculate interest upon that portion. 50 lakh into 8%, 4 lakh. 50 lakh into 8% is 4 lakh. 4 lakh into 3 by 12. 1 lakh. So this is my total interest for the year. 3 lakh 75 to Punjab National Bank and 1 lakh to State Bank of India. But the now question, another important question now coming to my mind. That is, the first point I have told you, in order to claim deduction for interest on loan, what is the first condition? Loan shall be taken for acquisition or construction or repair or renewal. Okay, that is the first condition. Punjab National Bank is loan, it's taken for acquisition. No doubt. But SBI loan is taken to repay Punjab National Bank loan. Is it not? SBI loan is taken to repay Punjab National Bank loan, but Punjab National Bank loan is taken for acquisition. So normally, we might have a doubt whether I can claim deduction for the State Bank of India loan of loan interest of 1 lakh. Let us see whether we can claim a deduction. Point number 4. Fresh loan taken to repay original loan. Interest on fresh loan is also admissible, provided original loan is taken for acquisition or construction or repair or renewal. Did you understand? So fresh loan is my SBI loan. SBI loan taken to repay Punjab National Bank loan. Interest on SBI loan is admissible, it can be deducted, provided original loan was taken for acquisition or construction or repair or renewal. All right. So we can claim deduction for 4,75,000. 4,75,000 is admissible. So that is regarding current year loan. Current year loan. Let us see what is this pre-construction period loan. Pre-construction period loan. Again, I will explain with an example and then we will read the theory part. I took a loan on 1/7/2021 for construction of a property, and for the calculation purpose, let us take it as 50 lakh loan at the rate of 10%. So that interest per year comes to 5 lakh. Okay, I took a loan of 1/7/21. The construction of the property had started. I took a loan from 1/7/21, but the property was registered in my name. Like the construction of the property was completed. Okay, construction of the property was completed. On 30th September 2023. Which means, what does this mean? I became owner of the property. I became owner only in 2023-24. The property was registered in my name. It was a flat that was being constructed. So usually when the construction starts, the developer, that is the flat builder, he will be taking money from you in installments. So for the purpose of paying those installments, I had taken the loan in 21 itself, but I became owner of the property only in 23-24. Now I let out this property once the construction was completed. I let out the property immediately on 1st October 2023 at a rent of 50,000 per month. Immediately that was let out. Let us calculate income from house property for this year. Income from house property. Gross annual value. 6 months, right? October, November, December, January, February, March. 3 lakh. Municipal taxes. Assume there is no municipal taxes. Okay, 0. So net annual value also comes to 3 lakh. Standard deduction 90,000. 3 lakh into 30%. Then there is deduction for interest. Interest we can divide into two. There is current year interest as well as there is pre-construction period interest. Okay, there are two interests here. One is current year interest and second is pre-construction period interest. Two interests. Now let us see how do we calculate current year interest. Interest, what is the rule for deduction? The rule for deduction of interest is allowed on accrual basis. Accrual. That is a deduction for interest. The interest which has become due for this year. That is what we mean by accrual. The period which is this year, 1/4/23 to 31st March 24. That is our year. So the interest which has become due for this year will be allowed as deduction. So we can claim a deduction for 5 lakh. 5 lakh is the current year interest. Let me mention the period also. The period is from 1st April 23 to 31st March 24. That is the period for the current year interest. Let me ask you one thing. Paying interest right from 1st July. Is it not? You have been paying interest right from 1st July because the loan was taken from 1st July. Loan was taken from 1st July. So but you were not owner of the property in 2021-22 and you are not owner of the property in 22-23. You are not owner. One of the first conditions that we have discussed here is if you want to open the head income from house property, you have to be owner. So 21-22, you had no house property income. 22-23, you had no house property income. Meaning, Meaning, you have not claimed deduction for interest for those years. You have not claimed deduction in 21-22. You have not claimed deduction in 22-23 because you are not owner to the property. You have no head called house property in 21-22 and 22-23. So you paid interest in 21-22 and 22-23, but you did not claim any deduction. So that is what is called as pre-construction period interest. I'll tell you one thing. Once you complete construction, I'll give you deduction for that earlier year interest as well. Once you complete construction, I'll give you deduction for that earlier year interest as well. And which is that earlier year for which you want to claim deduction. It is interest for the period 1/7/2021. Is it not? 1/7/2021. From that to up to which period you want to claim deduction? Up to which period? Current year from 1st April, you have already claimed deduction as current year interest. So your pre-construction period interest will be from 1st April 21 to 31st March 23. 1st April 21 to 31st March 23 is called as pre-construction period. Pre-construction period. And the interest paid during that period is called as pre-construction period interest. Okay, interest paid during this period is called as pre-construction period interest. So once construction is completed, you can claim deduction for current year interest. You can also claim deduction for pre-construction period interest. So let us define what is a pre-construction period. How do we define it? Pre-construction period starts from date of borrowing loan. Date of borrowing loan. It starts from date of borrowing loan. And pre-construction period does not end on the date of completion of construction. It ends on 31st March, just before completion of construction. It ends on 31st March, just before completion of construction. Because once you complete construction, the entire interest from 1st April onwards is called as current year interest. It's not called as pre-construction. Once you complete construction during this year, interest from 1st April onwards is called as current year interest. So pre-construction means interest up to 31st March. If you complete construction on 30th September 23, up to 31st March 23. If you complete construction on 31st July 23, even then 31st March 23. Interest up to 31st March 23 is called as pre-construction period. Okay, so let us calculate. How much is your total interest during the pre-construction period? 2021-22. 2021-22, since the loan was taken only on 1st July, there is only 9 months there. July, August, September, October, November, December, January, February, March. So 5 lakh into 9 by 12. 5 lakh into 9 by 12. 5 lakh is the interest for 1 year. So for 9 months, 5 lakh into 9 by 12. Lakhs at 10%. 22-23, you have interest for the whole year, 1st April to 31st March. That is 5 lakh. So total pre-construction period interest will come to 8,75,000. Total pre-construction period interest will come to 8,75,000. Okay. I'll give you deduction for this 8,75,000 as well when you complete construction. But normally, this pre-construction period may run to 3 to 4 years and your loan amount may be huge. So the pre-construction period interest may come out to a huge amount. So generally what we have decided is pre-construction interest will be allowed as deduction over a period of 5 years. Pre-construction interest will be allowed as deduction over a period of 5 years. 5 years commencing from which year? 5 years commencing from the year in which construction is completed. So I can claim deduction for pre-construction interest for 5 years starting from 23-24. That is the first year. Once you complete construction, your deduction will be allowed over a period of 5 years, which are 23-24, 24-25, 25-26, 26-27, and 27-28. Each year, I'll give you a deduction of 8,75,000 into 1 by 5. 8,75,000 into 1 by 5 will be allowed as deduction over 5 years. Okay, this is how we claim deduction. 5 years, we'll keep on claiming deduction. So once construction is completed, you have to see whether there is pre-construction period and all, and this pre-construction period interest will be allowed as deduction over a period of 5 years. So this year, my pre-construction period interest deduction will be 1 by 5 of pre-construction. 1 by 5 of pre-construction, that is 8,75,000 divided by 5. So this is a total deduction which I can claim. 1,75,000 for the next 5 years. So both current year interest and pre-construction period interest may arise. All right. So this is the definition regarding pre-construction, but let me make a slight change in this question. Slight change. One more extra point to be mentioned. One more extra point. I have done this question on the assumption that loan was taken and loan was not repaid. Loan was not repaid. Okay. If that is the case, this is the answer. Pre-construction period starts from date of borrowing of loan and ends on that date just before 31st March, just before completion of construction. That is a rule. Now let me make a slight change in the question. What happens? What happens if the loan is repaid? Loan is repaid on 31st December 22. Loan is repaid on 31st December 22. What is the total period for which you would have paid interest in this case? It is from 1/7/21 to 1/7/21 to. Do you pay interest up to 31st December? No, there is no need to pay up to 31st December, 31st March 23. There is no need to pay up to 31st March 23. You need to pay interest only up to 31st December 22. So in this case, pre-construction period will be from 1st July 21 to 31st December 22 because the loan is already repaid. You need not calculate up to 31st March. So when you end the pre-construction period, you have to compare 2 dates. When you end the pre-construction period, you have to compare 2 dates. Either 31st March just before completion of construction, either 31st March just before completion of construction, or actual date of repayment of loan, whichever happens earlier. Whichever happens earlier. That is the date on which pre-construction period ends. Okay. Pre-construction period always begins from the date of borrowing of loan. It always begins from the date of borrowing of loan, but you end the pre-construction period, compare 2 dates. Either 31st March just before completion of construction or actual date of repayment of loan, because interest is paid only up to that date, whichever happens earlier. So let us read what is the rule. Pre-construction period starts from date of borrowing of loan. It ends on earlier of 31st March immediately before completion of construction or date of repayment of loan. And deduction is allowed in 5 installments from the year in which construction is completed. Each year, you will get 1 by 5 as deduction. Each year, 1 by 5 of deduction will be allowed. That is regarding reconstruction bill. All right. Section 25, we'll understand better after we discuss business income, because that is connected to business income, TDS and all, that is connected to business income. So once we discuss business income, you will understand section 25 better. So now let us come to computation of income from house property in some special cases. Computation of income from house property in some special cases. You have two self-occupied properties for residents. Okay. You are staying in your own property. You are staying in your own property. Let us say you have a property in Bangalore. You have a property in Bangalore, and this property is self-occupied for residents. This property is self-occupied for residents. You have a property in Bangalore. You are staying in that property. Do you get any rent for that? No, no benefit, which means GAV is 0. GAV is 0. For self-occupied property, there is no deduction for municipal taxes as well. So net annual value will be also 0. Standard deduction will also be 0, which means the only deduction which you can claim here is for an interest. You have taken a loan for purchase of this property. You have taken a loan for purchase of this property. You are staying in your own property, but you have taken a loan. And that loan will be allowed as deduction. But you cannot claim the entire loan as deduction. Since income is 0, GAV is 0, I asked you, you need not take any income. So when I give you deduction for interest, I'll keep a limit. The maximum deduction which you can claim for interest deduction is 2 lakh. See, in the earlier question, that was a let out property. This was a let out property. So you can claim the entire interest as deduction, whether it is 4,75,000 or 5,25,000, whatever you can claim as deduction. But once the property is self-occupied, since your income is 0, there is a limit for your expenditure as well. There is a limit for your expenditure as well. So this income from house property will stand at a loss. It will be a loss of -2. Always self-occupied property will be at a loss. Self-occupied property will be at a loss. Self-occupied property for residents, the value of self-occupied property will be -2 lakh. Okay, income from house property will be -2 lakh in this case. So the rule, let us read. What are the rules? 2 self-occupied properties. This benefit you can take for 2 properties. Let us take, you have a property in Chennai as well. Chennai property is also self-occupied. That is, you stay 6 months in Bangalore, 6 months in Chennai. You have no plans to let out the property. Here again, 0, 0, 0, 0. But interest for both the houses together, you can claim 2 lakh. For both the houses together, you can claim 2 lakh. Because the limit of 2 lakh is fixed for an individual. It is not fixed for a property. Limit of 2 lakh maximum deduction is fixed for an individual, not for a property. So for Bangalore and Chennai together, you can claim maximum interest deduction of 2 lakh. Let us see the rules. 2 self-occupied property. Both the houses, GAV will be taken as nil. Only deduction is for interest. Only deduction is for interest. Interest maximum deduction you can claim is 2 lakhs. Maximum 2 lakh. But even if you want to claim the deduction of 2 lakh, you have to satisfy certain conditions. Only if the following conditions are satisfied, you can claim a deduction of 2 lakh. What are those conditions? Point number 1, loan is taken for acquisition or construction of property, which means this loan is not taken for repairs. If it is not for repairs, it shall be purchase or construction. Date of the loan shall be after 1499, on or after 1499. Construction is completed within 5 years from the end of the financial year in which loan is borrowed. I'm not bothered as to when you have when the construction is started. But once the loan is taken, the construction shall be completed within a period of 5 years. Then the lender of the loan certifies all these facts. Lender of the loan certifies all these facts. That loan is taken for purchase. Date of loan is on or after 1499. Construction is completed within 5 years. All these facts have to be certified by the lender. If all these 4 conditions are satisfied, you can claim deduction for 2 lakh. Otherwise, deduction is only for 30,000. Okay. All conditions are satisfied, deduction is 2 lakh. Otherwise, deduction is only for 30,000. So let us move about. What if a person has more than 2 properties? Like I have a property in Hyderabad as well. Hyderabad. I have no plan to let out the property. Now I have 3 properties. I told you this benefit that GAV is 0, that can be taken only for 2 properties. If I have a third property or more than 2, the third property onwards will be called as deemed to be let out property. Deemed to be let out. 2 properties at your option, at the option of the SSC, can be treated as self-occupied. All other properties will be called as deemed to be let out. Deemed to be let out means as if the property is let out. As if the property is let out. So what will be taken as GAV? There is no actual rent. What will be taken as GAV then? RER will be taken as GAV. The expected rent, municipal value, parent and all that. That will be taken as GAV. Municipal taxes which you can claim deduction. The actual municipal taxes can be claimed as deduction. Standard deduction you can claim. 30% can be claimed. Interest can also be claimed. No limit. No limit for interest also. This is a let out property. So you can claim everything. But which property is to be treated as let out and which property is to be treated as self-occupied? That is left to your option. It is for the SSC to decide which will be treated as let out, which will be treated as self-occupied. If he takes Bangalore as deemed to be let out, Chennai and Hyderabad will be self-occupied. If he takes Chennai as deemed to be let out, then Bangalore and Hyderabad will be self-occupied. So that is your decision. Make a decision after comparing in which option your income will be lower. Okay. So for a deemed to be let out property, actual rent is not there. So GAV will be RER. Actual municipal tax payment basis, we can claim deduction. Net annual value can be allowed. 30% standard deduction allowed. Interest is also allowed without any limit. There is no limit of 2 lakh for a deemed to be let out property. Okay. Now, next case. Next special cases. Part of the property is self-occupied. Part of the property is let out. Part of the property is self-occupied and part of the property is let out. What do you mean by that? My house has 2 floors. I have only one house. See? I have only one house. One house. But there are 2 floors. Okay, there is a ground floor and there is a first floor. There is a ground floor and there is a first floor. Okay, this is a single house. Ground floor is self-occupied. Ground floor is self-occupied and first floor is let out. First floor is let out. Understood. How do we value the property in this case? In this case, what we do is, we will do valuations for 2 units separately, as if they are 2 houses. As if they are 2 houses, we will do valuation separately. So GAV of a self-occupied unit will be taken as 0, net annual value 0, standard deduction 0. Interest you can claim a maximum of 2 lakh. And minus 2 lakh will be the maximum loss. Minus 2 lakh will be the maximum loss. This is a let out property, so calculation has to be done in the usual way. We have to compute RER, but RER will be given for the whole question. RER will be given for the whole property. RER will be given for the whole property, both first floor and ground floor together. So you calculate RER for the let out property. If there is a 50% unit, RER by 2 you have to do. First of all, find out what is RER for the whole property, and then we will divide that by 2. That is RER of the let out unit. Compare that with actual rent. Municipal tax is also divided by 2. If they are equal units. Net annual value also automatically that will be by 2. Standard deduction will be by 2. Interest also, total interest by 2. Total interest by 2. So the interest will be apportioned between these two units. Interest will be apportioned between these two units on the basis of the floor area, and others you calculate for the let out unit separately. So let us read the quiz answer. Part of the property is self-occupied, part of the property is let out. Valuation shall be done for two units separately. GAV of self-occupied unit will be taken as nil and only deductions permissible is by way of interest. Income of let out unit will be calculated as usual, but all items shall be taken proportionately on the basis of floor area. To the next case. Next special case. So this is units. Now what I am talking about is the next case is I have a property. This is let out for 3 months. Entire property. See, entire property is let out for 3 months and self-occupied for 9 months. Entire property let out for 3 months, self-occupied for 9 months. Meaning, part of the year, it is not part of the property. It is part of the year the property is let out. Part of the year it is let out. Part of the year self-occupied, part of the year let out. For a part of the year, the entire property, it's not part of the property. Part of the property was what we have discussed earlier, 2 units. Here, the whole 3 months, self-occupied for 9 months, or the other way around, whatever be the proportion. In this case, can GAV be taken as 0? Can GAV be taken as 0? No. No. GAV can be taken as 0 only if that part of that property is self-occupied for the whole year. For the entire 12 months, if you have self-occupied it, then GAV can be taken as 0. Here the GAV cannot be taken as 0. GAV cannot be taken as 0. We will find GAV as if property is let out for whole year. We are computing income in respect of this property as if it is let out for whole year, as if it is let out for 12 months. As if it is let out for 12 months. That is the way you have to compute income. This property is not called as a self-occupied property. This property is not called as self-occupied. So RER will be taken for the whole year. Municipal taxes will be taken for the whole year. Interest will be taken for the whole year. But actual rent will be taken only for let out period. So actual rent in this example will be taken only for 3 months. RER will be taken for whole year. Definitely, I think RER will be higher in most of the cases. When we compare 3 months actual rent with 12 months RER, RER for 12 months shall be higher. So this is the case. This is how we calculate GAV in a case where property is let out for part of the year and self-occupied for other part. Okay, let us read the theory part then. I think we'll be doing problems from this. Property is self-occupied for a part of the year and let out for the remaining part of the year. Income will be computed as if the property is let out for the whole year. Every item will be taken on annual basis. RER will be taken for whole year. Municipal taxes will be taken for whole year. Everything for the whole year except actual rent, which will be considered only for the period for which the property is let out. Actual rent will be taken for 3 months. Everything else for 12 months. Next case. Again, let me explain with an example and then we will see what is explained there. I'm a builder, real estate developer. So prestige builders. They constructed 50 flats. Construction was completed on 31st July 2023. During our financial year, the construction was completed on 31st July 2023. By 31st March 2024, they could sell only 30 flats. They could sell only 30 flats, which means 20 flats are stock in trade. 20 flats are stock in, 20 flats, yes, 20 flats are remaining with them. They are in the name of Prestige Builders. 20 flats are still with them, still with Prestige. They sold only 20 flats are still lying with the owner. If income tax department comes to know about this, what would the income tax do is? What would the income tax do? They would consider there are 20 flats in the name of a single person. What would they do? What would they do? They will call, out of these 20 flats, they would call 2 flats as self-occupied and remaining 18 flats. What would they do? Remaining 18 flats are treated as deemed to be let out. Do you remember that? They'll be called as deemed to be let out. But I think this is not fair if you do this with a real estate developer, because the real estate developer has not constructed these flats for the purpose of his self-occupation. He has constructed all these flats for the purpose of selling it out. Just because the sale did not happen does not mean that they are to be treated as deemed to be let out and self-occupied and all that. So this is not fair if you do this with a real estate developer. And the Act also accepts that fact. So the Act says that as on 31st March 24, none of the flats will be called as deemed to be let out. None of the flats are DLO, deemed to be let out. Okay, DLO. None of the flats as on 31st March 24. Because we understand it takes some time to sell the property once you construct some flats all around here. So we won't treat this as DLO. There is no concept like self-occupied deemed to be let out for a real estate developer in this case. But we'll give you time. We'll give you time to sell all these flats. We will give you time up to 31st March 2026. That is 2 years from the end of the financial year in which construction is completed. 2 years from the end of the financial year in which construction is completed. We'll wait till that. We'll wait. Okay. So up to 31st March 2026, let us assume that up to 31st March 2026, they could sold another 15 flats. Another 15. Sold another 15 flats up to 31st March 26. All right. Now tell me how much flats is remaining with them now. So I will wait for 2 years. 5 flats remaining. No more buffer time given. Now, even after 2 years, flats are not sold out. 2 flats will only be called as self-occupied and remaining 3 flats are DLO. So immediately I don't call those flats as DLO. Immediately upon completion of construction for a real estate developer, I don't call them as DLO. Okay, we will wait till 2 years. 2 years, when do you count? How do you count these 2 years? From 2 years from the end of the year in which construction is completed. Since it is construction is completed in 2023 July, we'll count 2 years from March 24. We wait till March 26 to sell the property. Even after March 26, the properties are not fully sold out. Now we will apply that principle. 2 flats are self-occupied, 3 flats are DLO. Okay. Next topic. Earlier, we had a claim deduction for unrealized rent, right? Unrealized rent. And there is also something called as arrear rent. Arrear rent means rent which is increased with a back date. Rent which is increased with a back date onwards, with a retrospective date onwards. Rent has been increased, but not for the next month, but from a back date. So all the rent relating to the earlier years will be now received. Okay. And those unrealized rent and arrear rent, if it is not taxed earlier, you have to pay tax whenever you receive it. So both unrealized rent and arrear rent, if you receive subsequently, that will be taxable in the year of receipt. It will be taxable in the year of receipt. But From that, you can claim standard deduction of 30%. If I receive an arrear rent of 1 lakh, I can claim a deduction of 30%. 70,000 will be taxable, but there is no deduction for your actual expenditure. You might have incurred litigation expenditure and all in order to claim this unrealized rent. There is no deduction for that litigation expenditure. There is a flat 30% standard deduction, and only 70,000 will be taxable. And by the time you receive this unrealized rent or arrear rent, some cases you might have sold the property in respect of which you have received this unrealized rent. See, I had a property in Bangalore and I had not received the rent in respect of that property. I filed a case. It has been 5 years since. Now, during this year, I'm receiving unrealized rent of that Bangalore property. The court has awarded unrealized rent. The court had collected this from the tenant and they have given me that unrealized rent. But by this time, I have already sold my Bangalore property. I have moved to Hyderabad and I have sold my Bangalore property. But even then, since this unrealized rent relates to a period for which you are owner, it is now taxable, even if now you are not owner. It is treated as an income of the year of receipt. Unrealized rent is taxable in the year of receipt. You need not be the owner in that year. 30% standard deduction is allowed. Okay. And the last topic in relation to unrealized rent is last topic in relation to house properties, co-owners under section 26. Co-owners mean property is owned by more than one person. More than one person. Then two persons will be together called as co-owners. If the share of each co-owner is definite, there is a document. For house property, we generally have a document, title deeds. The title deeds specifically mention about the share of each and every person. Then the share of each person will be taxed in individual hands. That is, we will find total income from house property as if there is no co-ownership. As if there is no co-ownership, it belongs to a single person, we will find total income. And the total income received will be shared between two persons in their respective ratio. Okay, share of each person is taxed in the hands of individual hands. However, if the property is self-occupied, each co-owner can claim a maximum deduction of 30,000 or 2 lakh, depending upon whether those conditions are satisfied. They're like loan shall be taken for purchase or construction after 1499, all those cases. Now, so even if the property is owned by a group, it will be taxed in individual hands. But if the property is owned by more than one person and the share of each person is not definite, we cannot identify share of a single person from the document. In that case, the two owners will be together called as association of persons. The two persons, the two owners will be together called as association of persons. So there is no taxation in individual hands. The AOP will be paying tax, and that part, the second part, will not be asked for an examination at intermediate level, because at intermediate level we have no AOP assessment. We have only individual assessment. Okay. So that is regarding co-ownership, section 26. We have completed house property as well. We have completed house property. So now let us try doing problems, okay, from house property. Okay, this is a question which has composite rent as well, I think. Not composite rent. That was I just answered December 21. We'll first do suggest answer July 21. Suggest answer July 21. And if time permits, we will do December 21, or else we'll do December 21 tomorrow, because that also contains provisions regarding composite rent and law. Ramesh, he constructed a big house. Construction is completed in previous year, 8-9. And this house has 3 independent units. Okay. Unit 1 is 50% of floor area that is let out for residential purpose on a monthly rent of 15,000. So that is unit 1. That is completely let out. There is an unrealized rent of 3,000. It could not be collected from the tenant, and a notice to vacate the tenant has been all given. No other property is occupied by the tenant. Unit 1 remains vacant for 2 months. So there is unrealized rent of 3,000 and there is also vacancy for 2 months. Unit 2, 25% of floor area is used by Ramesh for the purpose of his business, self-occupied for business. Self-occupied for business, we don't look into that property in house property. We will consider that property for business aspect. Okay. Person himself occupies the property for his own business. We won't consider that property for house property. Remember the 3 conditions? Remember the 3 conditions in order to the owner, then shall not be used for own business or profession. So unit 2, we need not consider here. Unit 2, we need not consider here. Unit 3 is self-occupied for residence. For that, we can claim that 25% interest as deduction. Okay, 25% interest as deduction. And the interest of that unit 2, interest of unit 2, which is used for business, will be claimed under business. It will not be claimed under house property. All right. So let us first find out income from house property, and then we will go to business. We will first find income from house property. So there are 2 units. We'll do it in 2 columns. Unit 1, 50%. It is left out. See, please don't use short forms for exam. Unit 2. Unit 2 is not to be considered here. Unit 3, self-occupied, 25%. Self-occupied for residence, we can consider here. Self-occupied for business, we'll discuss that in business head. Okay. So let us compute gross annual value. Gross annual value. Gross annual value of unit 1, we have to go to working mode. Prefer working mode. Here I know this is 0. Self-occupied unit, gross annual value is 0. So let us go to the working mode. Working mode, there are 4 steps which are required to compute working mode. First is we will be computing RER. When you compute RER, you have to mention how you have arrived at. We are computing only RER of unit 1, right? RER of unit 1 is only to be calculated. And when you identify, you have to mention all these things. Municipal value or fair rent, whichever is higher. This is how we have calculated RER, subject to maximum of standard rent. Subject to maximum of standard rent. Okay, this is your step 1. Step 1, you have to compute RER. We are computing only RER of unit 1. So everything has to be taken in half. Everything has to be taken in half. Because unit 1, 50%. Let us first find out what is RER for the whole property. RER for the whole property is 1,88,000 or 2,48,000, whichever is higher. 1,88,000 or 2,48,000, whichever is higher, which means we have to take 2,48,000. Then 2,48,000 or 2,28,000, whichever is lower. 2,28,000, divide by that 2. So it will be 1,14,000. RER of unit 1 is 1,14,000. Now let us take actual rent. Again, mention in brackets, how do you arrive at annual rent? How do you arrive at actual rent? Annual rent minus unrealized rent minus vacancy loss. minus vacancy rents. You get that. It is let out on 15,000. 15,000. 15,000, the property was vacant for 2 months. So only 10 months, 1,50,000. Minus 3,000 unrealized rent is also there. 3,000 unrealized rent is also there. So 1,47,000. Okay, actual rent is higher. Actual rent is higher. So actual rent is GAV. Actual rent is GAV. Is it 1,14,000? Actual rent is 15,000 into 10, 1,50,000 minus 3,000, 1,47,000. So we'll go to the main answer, 1,47,000. Now municipal taxes. Municipal taxes. Municipal tax, how much is municipal tax? 20,000. 20,000 is for the whole property. 20,000 is for the whole property. So here you get 10,000, here it is 0. Net annual value. Annual value is 1,37,000 and 0. Deduction under section 24. Deduction under section 24. A. Standard deduction. 1,37,000 into 30%. Here it is 0. Interest. Total interest for the year is 60,000. Okay. Total interest for the year is 60,000. See, this repairs is not to be considered. This is not to be considered. This ground rent and fire insurance premium. These all are not to be considered for house property. Instead, I am giving you a 30% standard deduction. Interest is 60,000 and that is for the whole property. So we have to divide that interest between these two in the ratio 50% and 25%. So here it is 30,000 and here it is 15,000, 25%. Interest. So how much is total income from house property? How much is total income from house property? Total income is, total income from house property is 55,900 minus 15,000. 5,900 is income from house property. This is just total income from house property. Now, after this, we have to compute income from business. Okay. That third property, that third unit, is it not? That's unit 2, which is self-occupied for business, that will be considered under house business income, not under house property income. So now let us come to business income. Business income. So all these information we have considered. Municipal value, fair and standard rent, municipal taxes. Income of Ramesh from business is 1,40,000. We are talking about that unit 2, right? Unit 2, which has only 25%, 25% floor area. So let us take this building. In this 25%, I'm doing my business. I have my office here. From this 25%, I'm doing my consultancy activity, my auditing activity I'm doing. And I'm getting an income of 1,40,000, but without debiting house rent and other incidental expenditure. Any expenditure which I incur upon this building, 25% is related to earning of business income. So all expenditure which I incur on this building, I can claim 25% deduction from business. 25% municipal taxes I can claim in business. 25% repairs I can claim in business. 25% interest I can claim in business. 25% ground rent I can claim in business. 25% insurance I can claim in business. Business, we all know there is no specific format. Any expenditure related to earning of the income will be allowed as deduction. Any expenditure related to the earning of an income will be allowed as deduction. So all 25% expenditure of this property, I can claim as deduction from business. So let us come to business income. Net profit as given. Net profit as given in the question. 1,40,000. Less related business expense. All 1/4. Related business expense. Principal taxes 25%. Principal tax 25% 5,000. Then there is repairs. Repairs. Again 25%. 1,250. Then there is interest. Again, everything 25%, 15,000. Then there is ground rent. Ground rent again 25%, 1,500. Then there is fire insurance premium. Insurance premium, 60,000 divided by 2. Divided by 4, 25%, 30,000, 15,000. So all these are expenditure. Any expenditure related to this building, 25% is related to business. All these can be deducted. Finally, income from business will be 1,40,000 minus 37,750. This is business income. Taxable business income is 1,02,250. House property income, we already got 50,900. That is taxable income. Taxable income is both added together. Prepare a separate statement, computation of total income, income from house property, 50,900, income from house property, income from business, 10,250. Okay. So let us do one more question. That is, it is essay December 21. Again, that is slightly different from the usual questions. So let us do that question as well. Ravi is resident and ordinary resident. He owns a property having different flats in Kanpur. Municipal value is 27 lakh. Standard rent is 29 lakh 80. Market value, fair rent is 30 lakh. Annual rent is 40 lakh. But of this annual rent, 10 lakh relates to various amenities. See, 10 lakh is for that gym, for that swimming pool, park, garden. So 10 lakh we have to charge under other source. Annual rent relating to house property is only 30 lakh. Annual relating to house property is only 30 lakh. 10 lakh is annual rent for other sources. One flat whose annual rent is 2,40,000 remains vacant and rent was not received for 4 months. Okay, so we have to compute what is vacancy loss and then we have to apportion that. He has a lot of expense. 4 lakh is the municipal tax. Arrears of municipal tax paid. Interest, there is interest. Then there is a lift. Lift, 2,40,000 is the total expenditure. So from that 10 lakh, we can claim this 10 lakh will be collected for lift purpose. So we can deduct that 2,40,000. Then there is a salary of 88,000 that also we can deduct. Anyway, but salary and 2,40,000 relates to other sources. So other sources we will keep separate. Let us first complete house property. Let's first complete house property. Before completing house property, I have to segregate annual rent of 40 lakhs into 2. Annual rent. Annual rent of 40 lakhs. Of this annual rent, 30 lakhs relate to house property and 10 lakh relate to IFOS. Okay. Similarly, there is a loss due to vacancy. Loss due to vacancy. Loss due to vacancy is 2,40,000 into 4 by 12. 2,40,000 into 4 by 12. 2,40,000 divided by 3, 80,000. That also I have to split. Now, what is the ratio of total rent between house property and IFOS? What is the total ratio of annual rent in the between IFOS and house property? It is 3:1. Is it not? It's 3:1. So out of 80,000, 3/4 is vacancy loss relating to house property, and 1/4 is vacancy loss relating to other sources. Okay, so here also we have to split. Vacancy loss has also to be split between house property and other sources. House property and other sources. So here the vacancy loss is only 60,000, 60,000 into 3/4. And here the vacancy loss is 20,000. Okay. So let us write the actual rents. Actual rent is 29,40,000. Here actual rent is 9,80,000. So these are the rents which we have to charge under both the heads. These are the rents which we have to charge under both the heads. Actual rent for house property is 29,40,000 and actual rent for IFOS is 9,80,000. Let us complete house property first. House property. RER is 27, 29 lakh, 27 or 30, whichever is higher. Municipal value or market rent, whichever is higher, 30. So RER is 29,80,000. Actual rent is 29,60,000. Okay. If there is no vacancy, actual rent is 29,40,000. Sorry, 29,40,000. If there is no vacancy, actual rent would be 30 lakh. Okay, which is more than RER. Step 3 is more than RER. So GAV will be 29,40,000. Now let us deduct municipal taxes. Municipal taxes. Let us read the second paragraph. Municipal taxes 4 lakh of financial year 23-24. It is 10% rebate is obtained for paying it before due date. So you get a discount of 40,000. Municipal tax deduction is allowed only on payment basis. You can claim deduction for the amount which is actually paid. Amount actually paid during the year is not 4 lakh because you had a discount of 10%, 40,000. So amount paid is only 4 lakh minus 40,000, which is equal to 3,60,000. Current year municipal tax paid is 3,60,000. Along with that, you had paid an earlier year's municipal tax. See, again, municipal tax is allowed as deduction on payment basis. 21-22, you did not pay municipal tax, no deduction for 21-22. Now you are paying municipal tax, I'll give you deduction. But deduction is allowed only for municipal tax, not for any interest on municipal tax which you have paid. So 1,40,000 includes 25,000 interest. Okay, there is no deduction for that interest portion. So deduction for 1,40,000 will not be allowed. 1,40,000 minus 25. 1,40,000 minus 25,000 comes to 1,15,000. So total deduction for municipal taxes 3,60,000 plus 1,15,000. 3,60,000 current year, 4 lakh minus 10%, and 1,40,000. 1,15,000. So 4,75,000. Net annual value. Standard deduction. Information is given regarding interest. So no interest. Finally, income from house property. This is income from house property. Now we come to IFOS, income from other sources. This is house property. IFOS, rent received is under IFOS, rent received is only 9,80,000. You may note all these in your working note. How did you get that 9,80,000 and all after deducting that vacancy? Now let us deduct the related expense. How much expenses have you incurred for all these? You have a lift maintenance expense. But lift maintenance expense, 2,40,000 is total lift maintenance expense, of which 30,000 is made in cash. We'll be discussing that in the next session. That is Anything which you pay in cash over 10,000, anything over 10,000, if it is paid in cash, there is no deduction for that expense. So 2,40,000 will not be allowed. Only 2,10,000 will be allowed. No deduction for expenditure paid in cash. Lift maintenance. Then there is salary of 88,000. Salary of 88,000. See, 88,000 salary is paid for collecting house rent and other charges. Okay. 88,000 salary is paid for collecting 40 lakhs. 40 lakhs. So 88,000 has also to be split between house property and other source. Part of salary paid is for collecting house property income. Part of salary expenditure is for collecting other sources income. How much is salary related to other sources? Only 1/4. Only 1/4. So 22,000 is the expenditure here. Okay, only 22,000 is allowed as deduction. 88,000 into 1/4. All right. 88,000 into 3/4 is related to house property, but there we cannot claim that deduction. Instead, we are claiming a deduction of standard deduction. We are claiming standard deduction. So here we can deduct only 22, and this is your total other sources income. 7,48,000. Okay, total income is 17,22,000 plus 7,48,000. So we have completed house property. We have done 2 problems. These 2 problems were slightly different from the normal questions. That is why I did it here. Okay, next session we'll start with business income. Thank you so much.